Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. What's up, everybody, and welcome back. Very excited for today's Q1 2025 Economic and M&A update. I've got 3 amazing segments and guests in store for you today. If you wanted to jump to one of the segments, all you have to do is go check out the show notes and you can jump right to that one. The goal of this episode is to help you make better decisions because as a privately held business owner, we have a lot going on right now, whether it's tariffs or if it's government cutting and spending, or if it's the refinancing of all the debt. We got commercial bank stuff going on because of the commercial real estate, private equity is in some pinch points. There's a lot going on, but you still have to run your company, make big decisions, whether it's locking in financing for your company or selling your business, or if it's going to be reinvesting and optimizing margins. We have to understand what the full landscape looks like, which is why I'm doing these episodes. So first, I've got Alan from ITR Economics on. He's going to be giving us real data on where the economy's at, where it's been, because over the last 18 months, we've had a shrinking of the money supply, which I am watching with all my clients. They've been struggling in various ways, but we can look at the context of the business cycles that Alan talks about from ITR, and we can forecast the future because M2 money supply growth is growing, and there's going to be certain things that are almost inevitable, and we can look forward and make better decisions and better bets. So he's going to be sharing with us what he is seeing, what ITR is seeing, and what the indicators are seeing. And then next, I got Jeff Buettner from ButcherJoseph, who's a partner of the M&A investment banking firm, who's going to be talking about what's going on in the acquisition space. What are the different industries that are hot on the market right now? Who are the buyers? What's going on with deal structures and multiples and bank lending in order to make sure that the buyouts are happening correctly and in a way that is greasing the wheels for deal flow. Lots of good information there. And then finally, I end up with Joe Brown from Heresy Financial. He's one of my favorite YouTube channels. He's got 300 and some thousand followers, and he's going to dive deeper into the macroeconomic picture of government debt, money printing, and why the financial system is a lot more fragile than we think about. And just to be clear, I'm constantly learning too. I am very passionate about all this stuff because I think that this material impacts how we make decisions. And I think by understanding this stuff, we can make better decisions. So if you like this material and you like this episode, share it with a friend. Please go on to the Apple Podcast or Spotify Podcast. Give the show a rating so I can keep doing stuff like this for you. Appreciate you tuning in, and I hope you enjoyed the episode. Alan, this is going to be super fun. It's been a couple of years, and like you had said, just a couple things have changed since you and I specifically connected, but I'm very excited to have you on the show.
Thank you, Ryan. It's certainly great to be here with you and be able to hopefully help a lot of people as a result of our conversation today.
Yeah. And the purpose of these updates is just, getting the peer inside of what's going on for the middle market, because you and I both have been, I know you were on the Vistage circuit for a long time before you ended up handing off to some of your trusty team members. And it's just fun for me, Alan, being able to hear what's going on with the people in the trenches. And you guys have done such a great job providing good data, and it's always cut through the noise and actually pay attention to the data so you can make good decisions. And I know that's what my clients are looking to hear and the audience is looking to hear. So, I just thought about just maybe we could start with a high level of there's a lot going on. We're not gonna be able to cover it all in this segment, but kind of just you had your 2024, 25, 26, 27 kind of big picture. Any thoughts about where things are headed? Because I know there's some people feeling some pinch right now, but I think the context that you guys provide is super important.
Yeah, they are feeling some pinch, and obviously depends on the market they're in, right? Some are, our 4 phases of the business cycle. A is coming off a trough, heading towards zero growth, and then B is above zero growth and accelerating. C is slower growth, and D is going down below year-ago levels. We have some folks now that are just seeing the beginning of that B. We have some who are solidly in the B, others who are still waiting for it. So I can understand why there is confusion, because if you're at a meeting and you talk to a group of people at the table, you're going to get conflicting input.
Yeah.
It really does depend on who you are. But to answer the macro question, the economy, looking at leading indicators, looking at retail sales, non-defense capital goods, new orders, excluding aircraft, which is an important measure for us, we're all showing signs of life. The rates of change, our lead indicators are all showing that they're beginning to pick up. So the second half of this year, for everyone that's positively correlated to the economy, second half of this year is going to be much better than the first half of the year. The rate of rise is not going to be, blow the doors off of you and make you wonder how life all of a sudden got so good, but certainly going to be better than the first half and better than 2014. And that good news is going to extend through 26 into 27. And industry dependent, there could be a slower rate of rise in 26 than in the second half of 25, but still up. And 27 is still up. And in a world with all the changes going on, still up.
6 feet above is better than 6 feet below is what I was always told, right?
Yeah, exactly. Yeah. Because it's a money thing, right? You and I both know that people who lead businesses have to be able to anticipate with a large measure of certainty what's going to happen so they can prepare. If you're judging based upon the moment, you're just going to kind of sit back and say, I'll act when I know. I understand that. I mean, that's perfectly normal. So what I respond to people who say, I'll act when I know is, okay, assume I'm right, though, and the lead indicators are right, and these signs are right. Start making your plans now so that when you know, you're not then trying to figure out what's going on. You're ready to
love it. I love it so much. And like, after becoming familiar with your business cycles and the different phases, the challenge that I see so many people run into, which is why the context is so important, is when you start feeling like if you're in the B and the C and like you're starting to climb out of that, people are usually making cuts when they should actually be making sure that they can lean into that growth. And so I was on one of my group calls with a lot of my owner operator clients, and they're feeling it, and they're feeling it. And so they're starting to make decisions, or could potentially make decisions, that will hinder their ability to grow into that growth phase that we want them to capture. And so I think the context and those leading indicators and the rates of change are so important. So that way, and Alan, I've seen it so many times where these owners, they take it personal, when they're down, and it's like, no, it's not a you thing. You know what I mean? Like there's a reason and a rationale behind what's going on, and we can anticipate it and just make better decisions.
Yeah, you're absolutely right. And the feelings part is always makes us smile here at ITR because we're economists, and economists don't have feelings. It's not about feelings. It's about the math.
Yeah. Well, go ahead.
Math doesn't mislead you. I mean, that's the nice part, right? Your feelings can be based upon the latest article or headline or conversation as opposed to the math. And when you use
and it's all the anecdotal conversations they have with suppliers, with customers, and it can be very overwhelming and stressful. But then you start to look at the bigger picture where things are going. And that was what one of the questions that I had for you. When I look at a lot of the leading indicator reports and stuff, I become very passionate about following M2 money supply growth and the Fed balance sheet. And I know you guys have been working on your Fed updates and stuff like that. And you can there's like the humps. Like there's a lot of correlation. I mean, is that where when you're seeing a high correlation to the economy, where it's tied to that? Or like, and obviously different sectors are different, have different ways of being reacted to that. But I'm just kind of totally curious from my own perspective.
Certainly on a macro basis, the money supply, it's funny, back when Greenspan was in office, if you remember back there, for a while there was a disconnect between M2 measure of the money supply. We use M2 deflated to take inflation out of the picture.
Yep.
And for a while there wasn't anything, then it came back in again. And right now, in the last few years, the tightening of the money supply is certainly correlated with 2024 and what we see early here in 25. But now the money supply is beginning to expand again. And if somebody wanted to your point, it's a great indicator. So if somebody wants to know why will 25 be busier, that second half is because there's more money out there. When there's more money out there, then banks can lend it, businesses can borrow, consumers can borrow, and they invest. And it's the fuel for the economic engine, right? It's about the money.
Well, that's what it's so helpful because, between your data that I follow and then the M2, it's like, hey, like, look at what's going on. Like, look at, they dropped the money supply, the repo market, they've sucked that dry. And now you can start to see that upward trend going. And then that just gives us confidence because I've been people in the home building or commercial cleaning or steel fabrication, and there's all the different noise going on. It's like, hey, So look outside outside the trees to see the forest, and then we can start being hopeful. Keep your margins in lockstep and making sure that we're just like you said, making the plans, but it's that hope that I think is so exciting about it, the data and how clear it is.
Hope sounds like an emotion to me, Ryan.
Fair. Strategies that become more probable.
There we go.
Oh, too funny. So then, like when you think about the 2025 growth and 2026, and that's correlated to a lot of the things that we're talking about, I'm curious, Alan, is like watching how much has to be refinanced, and we don't have to go too far down this rabbit hole. I'm just kind of curious on the kind of the cliff note, or the surface, if you will, of with how much we have to refinance this year from treasuries and then commercial real estate. There's all these different refinance structures that have to be addressed this year. Yep. And then you have different sovereign nations and banks and pension funds that are going, hey, I don't know what our appetite is to lend. And so even though the Fed is reducing rates, the 10-year has not necessarily direct correlation with the Fed rate. And so how do you see what might be going on from the refinancing of this debt and how that impacts everything we were just talking about?
Well, you can look at the amount of money banks have on deposit and get a feel for their ability to lend. Then if you look at the reverse repo facility, it looks like they're running on empty, but that's actually a norm. When they want to spur the economy, it can go up, and when they want to deal and fight inflation, then it comes down. We're at a neutral position, and that's good. I mean, that just means that it's a calm on the water, the wind's blowing, and there's no need for heavy safety measures to be in place one way or the other. I think you hit upon a really important subject, though, with the commercial real estate. CRE is going to be a problem this year. I mean, there's an incredible amount of refinancing that needs to be redone, And in our view, we're going to find a good number of small to medium regional banks that are holding too much in the way of commercial mortgage that will be underwater. They're going to find the asset valuations have to be reduced. It's going to look like what we went through, 2 years ago. And it's going to scare people to death. And the people listening might start hearing bank failures and go, oh my gosh, it's 2007 or 8 again, or it's 2000 whatever again. And what I'd like them to understand is we're anticipating this, and that's part of the forecast. And so it's not a surprise to us. And all it means is that the big banks will be buying them, or the Fed will be guaranteeing them and shore them up. So the names may change on the door and on the letterhead, but the institution will still be functioning. Nobody's going to see their deposits gone. Nobody's going to see all this great catastrophic 1929 thing. That's not in sight. Even with our outlook for the Depression, that's not going to happen because of the laws that we have in place, FDIC and Federal Reserve Board. None of that existed in the past, and
I think they've set the precedent with Silicon Valley Bank and was it Signature?
Yep.
Yeah.
Yep.
So you'll get a kick out of this, Alan. When that was going down in Silicon Valley and some of that contagion started like rippling through, I was like, oh, I had that one banker on my podcast and it was the founder of Signature. And then I realized he was part of the problem. I'm like, I don't think he's going to want to talk about this. So, I find it fascinating to your point. The precedents have been set that they're going to keep things going. And with that precedent being set and that being incorporated into the data, it's like, well, then we shouldn't be panicking because, I always go back to the name of your book of Prosperity in the Age of Decline. Like right. The people, and that's really, it's taken me a long time, Alan, to be honest, to get there, which is like, because I want the whole system to be perfect. You know what I mean? I want it to, but then it's like, well, the people listening in and the people doing the hard work are the ones that truly have prosperity because there's like the discipline that people listening in with the 3-statement forecast and like building out their actual plans, knowing their numbers can make bets that other people without the data just are going to be panicking or not making.
Right. Exactly. So, and the ones without the numbers could easily be turning in the wrong direction instead of filling their sails with the wind. They're They're getting swamped. It's the thing that gets pumped into my mind too is that banks fail every year. It's only when they get reported on that people start getting really nervous. And it just strikes me as interesting that it's selective reporting that seems to scare the herd.
Yeah, yeah, and knowing the context is just the name of the game of what we're trying to do here. And so, so it makes sense about the commercial real estate. Is there anything that is worth discussing around that $7 trillion that's got to be refinanced this year? I mean, like I'm just fascinating. Like, how are they going to handle that? And like, is it more money printing, or is it bank regulations that they're going to change in order to like absorb that into the banks? I mean, I'm just kind of curious on how that impacts it, because if we refinance it on new rates, it increases the deficit. That's already an issue. So then are we printing to refinance that? And then like, how does that conundrum, what should we be thinking about that conundrum?
Probably look to increase the deficit, because printing money, which you and I both know doesn't actually occur. It's not an actual physical printing of money, but the digital creation of money adds to inflation. And last thing the Fed wants right now is more inflation. So, and the Treasury doesn't want more inflation. So,
right,
unless they're ordered to print money, they're not going to, because money creates inflation, which creates higher interest rates, which increases the risk of a downturn.
Yep.
And they're going to be very afraid of that. So that just means we're going to be borrowing at higher rates and make the deficit worse. And in the future, that's when it comes back to bite us. Bernanke did a great job at financing at low rates, but when those are coming due, they're coming due at higher rates, to your point.
Yep.
And that's going to continue on with larger and larger dollar amounts necessary, so that the federal budget payment on interest will be growing and growing. Right now, it's equal to what we spend on defense.
I know.
It's just going to keep growing until younger people like you, as opposed to older people like me, you're going to have to deal with this, Ryan. I'm really sorry we did this to you.
Yeah, we're footing the bill. Well, and this is where, because Alan, it's so fascinating to me, because with the privately held companies, I live inside of a 3-statement cash flow where it's, hey, we either have free cash flow after working capital, debt, taxes, and reinvestment, or we don't. It's like gravity. It either exists or not. There's no emotions, right? To your point. And like with the government, it becomes slightly more complicated with the different numbers and the different ways that they can borrow to finance that deficit. So when I think about, bear with my thought process here. So like when I think about a 3-statement model with the government, it's like, okay, you have revenue from taxes or tariffs. But then at the same time that we're refinancing at higher rates, there's 4.5 million baby boomers retiring each year. So that's like 30 million between now and 2030. So is this where like that whole kind of pinch point happens in the 2030? So all of this is kind of going and saying like, we have a runway effectively for 60 months until I was trying to explain it to someone else in one of my Vistage workshops. And I said, can you imagine taking all your salespeople and throwing them into the accounting department? Like, that's what we're going to be doing over the next 5 years. Like, all these revenue producers for the country are going to go sit in the back office. And so that all of that just kind of puts that pressure towards that 2030. Is that a lot? Is that part of the data that you're looking at?
That is definitely part of the data that we're looking at. And while there are some taxes paid by retired baby boomers, it's nothing compared to what we were paying while we were an active part of the workforce. So that means the Gen Xers and the Gen Ys and Zs are going to be paying more in taxes to support us, or they're going to cut off our benefits. Cutting off our benefits can't work because we still vote.
Right.
And, we're the largest demographic, so
right.
It's not likely to change. And if we're in Illinois, we vote more than once. I mean, so we're just going
Oh, that's too good. So like this is, I think, something that this issue that we're talking about is becoming more and more commonplace to have discussions with. And you guys have been at ITR been talking about for a long time, but now it's like that whole debt to GDP and the deficit, everything is becoming more like, this isn't a free for all forever. And so there's conversations about AI boosting productivity, and I'm an optimist at heart, but I sit there and go, okay, how much productivity would we need to enable to overcome this? So like, what do you see as far as like technology and AI as productivity and a percentage of impact potentially, or however you want to frame up, like, what are your thoughts of the fact that factor? And the reason I bring this up is I actually, I think it was either you or was his name Alex Chavarsky
Kavosky, yeah.
yeah, he was on the show. And like, this is years ago before I knew as much as I do now, or the learning curve is, technology has always changed in economics. So like, it's always kind of factored in. Is this kind of the same thing where like we're kind of factoring in that kind of growth, or is there maybe a different X factor here? Do you see?
The speed of implementation would be the change in X factor. And I'm one of those that think that it's great, it's exciting, it will certainly make a difference, but not at the speed at which people think. It'll help with the tight labor market in many areas, but again, it's implementation through time. I'm sure you remember when electric cars first came out 15 years ago, it was like, well, I'll be driving electric cars in 5 years. Well, we're still not.
I got to tell you, my best friend from college who owns his family business, he bought it, and he is a CPA by trade, bought a rental company, and so he literally wears work boots every day. But he's an internal pessimist, and I'm an internal optimist. And I will never forget, Alan. We were sitting around the bonfire right after we graduated college. I'm in my early 20s. We had a printing business, and we sold copiers and did printing. And I was like, "They're all going to be gone. It's going to be 5 years. They're all going to be gone." And he was like, "Never." And here we are, it's 20 years later, and it's like, they're not going anywhere. So like, I completely agree. And I look at the challenge of change management with people, and like, I mean, they're still using paper in some companies, to do processes. So I definitely understand where you're coming from on that.
Yeah. We actually think that next decade, there'll be a transformative technology, bigger, better, more disruptive than AI, that will help fuel the 2040s and into the future. And the
robotics, and I mean, you name it.
Maybe it'll be transporters, maybe it'll be space travel, maybe it'll be, you name it, but something that we are not really. I like to think of Back to the Future, where we're going to have Mr. Trash, and we'll just deal with a whole bunch of problems with Mr. Trash, for our engines. But one of the things that speaks against my economic nature is that when you look back through history, humankind, have faced a lot of challenges, whether it's climate or whether it's been technological, societal changes, and yet somehow we come to the other side better than we went into it. So this depression that's coming is not going to be pleasant for a whole lot of people. But if we look at the larger, I think we're going to learn that, carrying a bunch of debt is not a good idea. Making all these promises without the revenue just is a stupid thing to do. And I think we're going to come out with a firmer grasp of fiscal reality. And to your earlier point, Ryan, which you mentioned, the government and spending and stuff, they don't think like we do. They believe in modern monetary theory. MMT is what it's called. I call it magic money tree. They just think And they don't use GAAP. I mean, they don't use accounting that people in businesses do. So when they say things, we hear it through the lens of GAAP, but that's not what they're speaking at all. When they say
double entry accounting, what are you talking about, Alan? I don't understand.
Yeah, it's just amazing. And so,
well, it's I got to show you. So this is what I do. I actually text a picture of this to your daughter when I was on vacation. This is the book I'm reading right now, which is the History of Money and Banking, or History of Money and Banking in the United States. That's what I read on vacation, right?
Yeah, it's good reading.
She goes, "Oh, you would make my dad proud." And it's like, I found it so fascinating, going back down to the 1600s of like the hard money versus the soft money, gold versus silver, and like. Yep. I just find it just an unbelievably fascinating, because he's going through accounts. Like, here's the numbers, like here's what was going on. And then that provided me just so much interesting context to then the politicians that were coming in and out of office. And when I think about the 2030 Great Depression and what like, where do you see like the role of the dollar, and like how, like, because like when I think about we can inflate our debt away, which has happened in the past after World War II, like, then there's productivity. So like, is it just like, I mean, like, how do you get out of that hole? And is it a combination of all that stuff? And that's kind of to your point where we've kind of handled the multi-factored situation in the past, and that's just going to kind of smooth itself out over time. Or any thoughts on it?
I agree with what you said, and I'll add one more. One of the major drains going into the economy are baby boomers. The peak death rate for baby boomers is the late 2030s. So the faster that we die, the easier it is for you to fix the problem because we won't be draining the system. So we should start a war involving only old people. And
What is that going to consist of? Bingo and Scrabble at a Perkins, and then
well, it will require afternoons off. There's no doubt about it. Afternoons off, and then
oh, it's interesting.
But you're right. It is multifactorial. Nothing is linear, right? In that simple. Going into this thing is because of debt and because of government decisions around the world. It's certainly not centered here in the United States alone.
Right.
And the baby boomer generation did a lot of good, but at the same time, now we're becoming a drain. And it's
well, isn't it fascinating though? After following ITR, I mean, we have the millennials though, like, and I know, I think Mexico is a lot younger too, right? So like, you know, in the Americas, like we have more going on with natural resources. We have younger people than other countries across the world as well. So there's a lot actually going on for us. I feel like that most people might not realize.
Oh, you're absolutely right. And put it in the context, if you would, though, of millennials in a rich nation with rule of law and natural resources and strong navy and world trade going on, because there are developing nations, other nations that have a very young population, but they don't have the other advantages.
Right.
Have you read Peter Zane's book, The End of the World is Just the Beginning?
Yeah, and then I read I've read a couple of his books, and then I also wrote the update on the 10-year. I can't remember what it was. It was the update. He had a 10-year one. It's 10 years of look back or something like that. Yeah. I mean, very interesting. It provided a lot of context on where the resources are and maritime and how important that is, and the Navy, and like how that helped with the world war or the world order after Bretton Woods. I mean, very fascinating stuff.
It was. And I spoke recently at a place where he was there, and Neil Howe, who wrote The Fourth Turning, was there. So the three of us spoke.
Just got done with that book. I love it.
And yeah, it was a fun conference because we three of us all got to talk about the end of the world as we know it. And
just great coffee talk. I love it so much.
Cocktail hour is popular. But the bottom line is that in each of them, the timelines may differ and some of the reasons may differ, but they all end with an up. They all end with things getting better. None of the three views end with, and that's how the world ended.
Right. It's what's so fascinating, Alan. So actually, on that vacation, I was also reading The Fourth Turning.
Okay.
And my buddy that texted me that book, he follows this. We're in and out of the. I mean, you should. Probably similar to your coffee talk, like not for the faint of heart. But like I said, like to look at The Fourth Turning without the money is absurd. Because I was reading the history of U.S. money and banking and The Fourth Turning, like, and this is all tied together. And then Peter Zion's, and then Ray Dalio's got his economic cycles and all that stuff. I'm like, all this is super tied together because the money situation is what creates the inequality and creates the debt, and like so a lot of which then precipitates the behaviors of the people in the country. And what do you like? How does that impact where I go with my mind? Is like my cohort. So I'm technically one of the earliest millennials. So I was born in '86, and how like when I look at the wealth inequality, it's disproportionately in the boomers. So there's the wealth transfer that's got to happen, and like so I look at in Norton's world where we're talking to business owners of companies, it's the who's going to buy the company, but also who can run the company. So there's like a skill issue and a financial purchasing power issue to facilitate these transitions that's got to happen. Yep. And it's not a 1-for-1, I guess is my point, Alan, where it's not, you don't have like 80 million boomers and 80 million millennials and everybody's got the same amount of money to transfer these assets. So there's kind of this issue that I've seen of like how that could potentially be facilitated or have challenges.
I think it'll have challenges. And it's amazing how many people think it'll be that 80 million to 80 million, this massive transfer of wealth that'll make everything all right. And it's very narrowly focused. And it's not ubiquitous by any means. So it will be difficult, and it will provide some disparities that will become, unpopular in
Yep. And
life.
challenging. Yeah.
Challenging.
So like, here's one thing that I have continued to explore in conversations with other people that are deep in the numbers too. So I've got this U.S. Census Bureau screenshot that someone sent me in the M&A world. And it was like the list of how many privately held companies there are. And I know there's like some ambiguity and it's kind of fuzzy around the edges. But like, if I even say, okay, it's like 70% accurate from a concept wise, it's like 94% of the companies that are privately held are below 5 million in revenue.
Yeah.
And then the rest are above that. And then because I've been inside of the world of finance and M&A for a decade now, I you go on the news, just like you and I just despise all the clickbait stuff. I'm like, well, you can buy these companies, SBA loan, 10% down. I'm like, well, even a company with $1 million in normalized EBITDA, that's not cash flow. Right. And then you go, okay, well, you have to have a 10-year note and assume everything goes perfect. And we're going right into the 2030s. So like when I think about it, Alan, it's like, okay, well, of that cohort of companies, there's going to be a lot of these companies that actually can't even facilitate the monetary buyout of these companies. So they have a job and they might have some distribution. So they're making, call it like 250 grand ish. And you go, okay, well, in order to facilitate a buyout for you to retire, like there's no cash flow there.
No, that's right. It becomes very difficult and a trap for a lot of people. I happen to be someone who really likes ESOPs. And I think that helps
Amen.
wealth
like
distribution and the responsibility. You're there too, I see. Right?
Yeah, conscious capitalism. I've done a bunch of ESOP miniseries. I've helped facilitate quite a few of them. I'm not for everybody, but like the purity of like the capitalism and the working for earning equity with your labor, I think is a fantastic mechanism.
I'm on the board of one, and our stated goal is to make as many millionaires as we can.
I love it. Yeah.
And as a board, our whole focus is on the stockholders, who are the employees, who are the people who make this business work, and it's just so rewarding to see that.
Isn't it? Yep. Yeah. I'm actually a fiduciary on the board of an ESOP as well. And you know what's fascinating, and I don't know if this is kind of what made you think of that, is like I actually look at like the actual financial structure of these buyouts. If you eliminate the taxes, there's more cash flow to service the buyout, whether it's seller financing and bank debt. So like if I was, king for a day, I'd figure out how to have these business owners, because I know there's specific, circumstances and regulations on, okay, you got to be, 20 employees, you got the DOL discrimination law, and you got to be about $1 million in normalized EBITDA. I feel like there needs to be a way to facilitate these transfers on the lower end of the market with ESOPs, because then we could like free up and help some of these transfers to the people that are doing the work, so these companies don't just go into the void. I don't know. I don't know how it could be potentially be possible. I feel like there's something to explore there for the people listening in.
Well, sure. Another way to do it outside of the ESOP and the tax benefits of an ESOP is to just have employees have stock options or the ability to buy stock. And they're just straight stockholders and not through the ESOP. And you don't have to make it available to everybody. It can be based upon it's earned or your position in the company and the value you provide. I mean, there's lots of ways to do that, but it's still a nice way to transfer ownership from a one or a family to those that make it work. And yeah, I see nothing wrong with that either. I just enjoy seeing that. It's just, that's my little, autonomous heart.
It does. Hey, you're not supposed to have feelings.
It's a very little heart.
Okay. The one that I was told I have.
Yeah, that's
right. So on that note, and I'm making sure we got the time, I'll get you out here in 10 minutes. So people, so like if we have a good strategy, like to kind of back into hitting the I believe buttons, we've got the rates of change, we got the economic indicators that ITR is providing. Someone has a 3-statement forecast, which I'm just like, I beat that drum all day long because it gives us visibility into the trade-offs. And then it's you got to have a strategy, but then there's this people component where when we have so many people retiring, people that can attract talent and keep talent I think are going to be able to actually recognize that growth. Have you seen anything interesting that people are doing? I have a lot of my clients talking about, people strategies, apprenticeship programs and stuff like that to get a bench full of people. And I mean, any thoughts on the people component of this?
Yeah, you're absolutely right. Is the overriding thought. It's about the culture, and to me, it's about empowerment and listening to the people that work with you and for you, but making sure that that they know they are heard, and make sure that you really are listening, that your EQ is high. There's lots of good ideas they're going to come up with. Be listening. They have a lot to say, and they will see things that a business does that they shouldn't be doing anymore. But if I've been running this company for 30 years, I'm blind to all that stuff, right? But somebody coming in from another business and they got a couple of years here, or maybe they have 6 months, they go, Alan, why are we doing that? Instead of just dismissing it, you should say, that's a really good question. Let's think about that. And when you have that type of culture, the word spreads, and all of a sudden it is easier to hire. Your turnover rate goes down, retention goes up, and it's I think it's something that works really well. It has to be very intentional. You spend time, and you spend effort on the networking and on the team building, but it is pays in spades. It's just wonderful.
And I also find that also contributes to everything that you just said, which it's funny because you brought up all the fuzzy stuff and I'm going to the numbers. Is the clarity in the outcome. So one of the parts of the independence by design owners framework is with that 3-statement model, have a ground up annual budget month by month, all 3 statements, not just the income statement, but month by month. So we can look at budget to actual every month, but then have a out year projection with high level per year to essentially 2030. That's because, it's now like kind of the 5-year. But what happens that I've seen, Alan, is that if someone can, like an owner can see, hey, this is what I would make in distributions after working capital, taxes, reinvestment with my plan, and they've got that context, they can then be way more transparent in kind of like the great game of business kind of methodology. They don't have to have full open book management, but Jack Stack was on my show years ago and he's like, why have a dashboard when you got the income statement? And so then back to empowering the younger generations.
Oh, yeah.
Instead of having everything be subjective, it's like, hey, here's the plan. And I just find that having a plan is actually differentiating for these owners who are trying to attract people, because otherwise there's no growth plan. Back to the whole, people don't know why they're doing what they're doing. But if you can show them how what they're doing is impacting a bigger picture, I think that there's also that puts rocket fuel on the culture and the listening that you were talking about.
I agree, and Jack Stack and I go back a long way, and I believe deeply in his great game of business and methodology. And you brought up a point about making a difference. Millennials are known for this, and that is they want to do well, which means get paid well, and they want to have a good life, but they also want to do good. And they want to make a difference in the world. It's important to know that when they're going to work, they're doing something positive for the world. And my joke is you just use the word, recycle and environment 3 times in the interview, and they just, believe everything you're saying after that. But you have to let them know that, and this is what we've done, and lots of businesses do. Profits are not bad, because with profits, we do this, and X amount goes to feeding people, and X amount goes here, and X amount goes back to you, and so that there's a sense of I do well and I can do good if I'm helping be profitable.
Well, and I agree with everything you're saying there too. But even if someone didn't want to do that, what I've seen is like, hey, if you're in the marketing department or you're in operations, here's how what you're doing is contributing to the whole. Yeah. Just even if it's someone stopped there, but so few people can even put the whole picture together. It's like all these silos and all the things are looking, different. It's like, hey, if I do all of these things, that contributes to the whole machine. And it's just like back to I think the common theme is like by doing that thought process and planning all this stuff out and understanding where you're at, that's the only way you can actually communicate it to others.
Yep.
Otherwise, you're just kind of guessing yourself. And I think what ends up happening is I've seen, curious on your thoughts too, is like I've seen the people that are guessing they're the ones that are actually kind of in a conundrum, because then everybody is kind of seeing that you're just kind of guessing, and then it's you versus me versus so if it's almost like the individuals against each other in a company versus us two sitting side by side looking at the goal. So it kind of takes it away from the the kind of the confrontation internally towards the outside, and it just fuels productivity in my mind.
Oh yeah, it certainly does. I used to. Oh, it's been years now, but when at corporate get-togethers, I had this PowerPoint that I would use that showed the different departments as gears and how we were all meshed together. And if one of them broke, the whole thing
right.
fell apart.
Yeah.
Really simple, but it got the point across, right? And it also said, you're no more important than accounting. You're no more important than marketing, because we all need each other.
It's a complex system. It's an ecosystem.
Yeah.
Given the time, so tariffs. By the time this goes off, who knows what'll be different? But maybe just more like, because I think what's constant or what's consistent is chaos. But like with that, like how should people be thinking about tariffs? Having conversations with distributors, suppliers, customers. Any thoughts about how someone could navigate just the uncertainty that's going around?
Yes, and the answer is that it is a very complex subject, and there's a list of things that people need to go through. And this is being recorded, so you can edit this out. But Pro has a free analysis that they will do for companies on if you're subject to tariffs, are you paying more than you should? Do you have alternate means to recognize things? And it really does help companies. So that's number one. I mean, you got to really know where you fit and how you fit, and if you're paying too much. Number two is with the whole subject of tariffs, my thought and what I tell people is don't overreact, because for all we know, this is just the club that's being wielded to get other things accomplished.
Yeah.
Don't start building your life upon this. Just start building a plan upon this, and don't move your plant out of Mexico because of this, because you could spend $10 million just to find out in 6 months that it's all back to normal. So
because I mean, like what I've watched is the 10-year Treasury has already gone down 0.5%. Because of just the conversations that are happening, let alone implementing any of them.
Yeah.
And I think back to then your data, it's like, okay, having those conversations, seeing them, and then back to watch it, but don't react until something actually happens.
Right. And if it's like 2017, 18, where we saw the steel and aluminum and other tariffs, the inflation impact didn't last that long, because a lot of carve-outs began. So that's the other thing to watch for, is if we have everything's going to be 25%, how long does that really last before the carve-outs begin? And we've already saw a little of that, which all of a sudden the automobile industry gets an extra month, right? And if carve-outs start happening, that really takes a lot of the inflation out of it. And it becomes a cost that is absorbed by the seller and the buyer and in the supply chain in this country. And next thing you know, it's not really as impactful as people fear.
And there could be M&A opportunities for people too that are paying attention and understanding where they're at in the supply chain and in that situation. And I think it's also fascinating as kind of a last quick comment is, even with like the government spending, even if Doge goes in there and actually does the cuts, who knows what'll actually come through from it. But like I've got a client that does some work in the they're exposed. I won't disclose anything other than that they're exposed into this place where like, oh, there's all these cuts, and there's a lot of panic going on. And in the next comment, they're like, we have so many workers we can choose from right now because there's all these cuts going on. I'm like, like, which one of those do you want to be? They can both be true. So like, it's like this interesting thing. Like the government was the one hogging all the talent, and now there's this talent available that then also can be monetized through your company. So it's just a fascinating, back to your kind of, even with the tariffs, the context really matters.
It does. And I have yet to meet somebody who doesn't think the government is overblown and needs to have cutbacks. But I happen to be somebody who believes in scalpels more than I do chainsaws,
where's the actual, I track you. Well, and I think back to then the business owner's actionability, just paying attention. So how and having a plan. So how do you capitalize on this? I know you got to get running here. This has been a blast already. So any food for thought for the owners that are paying attention? Any, you don't have to come up with some magic comment. Just curious if there's anything we didn't cover.
No, it just circles back around to pay attention to the data and try to ignore the news and the worry that is out there, because there's always worry. And if you're driven by the worry, it's safe to be in the herd, but you don't lead when you're in the herd. If you're a leader, just ignore that and pay attention to what actually matters.
Alan, thank you so much for coming on. This has been an absolute blast.
It has been fun. Thank you very much, Ryan. I'll tell Kim you said hi.
Well, Jeff, excited to do another quarterly economic update. We had ITR coming on, and then I had Joe Brown, another individual talking about macroeconomics, and we're here to talk about the middle market, the deals, what's going on. And I got questions because I got a lot of clients that are in different phases of what they're trying to do, and there's barely anything going on in the economy. So I don't even know what we're going to talk about.
Yeah, it's been really quiet. Sure. Okay.
Like, I don't even know how much time we got here, right?
Right. Well, good to see you. As always, appreciate your time. But yeah, I mean, wow.
Where do you want to start?
Yeah, exactly. Where do you want to start? Probably different places we could start. I mean, I'll tell you. Well, I guess where I would start is just that, like, ever since the new administration came in, wow, just a lot of different things happening, and
where's the buck?
A lot of different things happening that are quick, fast moving, unexpected. Some things more expected than others. I think, the concept and the idea of, tariffs has been on the table for a while.
Mm-hmm.
So hopefully that didn't catch anybody off guard, but there's a number of other, sort of changes coming out of the new administration that certainly has, and it's impacted businesses a little bit. I think some businesses are still trying to figure out, how and if anything that's coming out of Washington might impact them.
Yeah.
Certainly tariffs is the more probably well publicized.
Yeah, it's the one that's being discussed. Maybe what we could do here, Jeff, is I'll throw out. I mean, I got a handful of bullet points that we can cover, but maybe just giving you just a cliff note of what I'm seeing with my clients and kind of the conversations that I'm having and some of the things that I talked about with Alan from ITR. So, like, tariffs is one of them I definitely want to get into. And just a small story, I got a guy that I'm working with, and he has a company in Canada, and he was literally in the process of selling his business, and then that didn't happen because so the 25% tariffs on and off and stuff like that. So varying different, manufacturers I'm working with and professional services have different implications, whether they're coming or not coming and how to handle it. But then also something that I've absolutely noticed with it's in plain sight with my clients is the slowdown that's going on right now. And, and I've been, preaching, M2 money supply growth has been shrinking for about 18 months now. And that's highly correlated with ITR's leading indicators. And now we're on the ramp up, right? So there's very good indicators of where things are headed over the next 18 months or something like that. So I'm kind of curious on how that may or may not translate into the M&A marketplace, and then where people are going for different industries and different sectors. But I mean, that's what I'm seeing. It's kind of the big point of this whole economic update is like context, right? Yeah. Like we might be feeling some pain right now, or there's a lot of news headlines, but like let's make intelligent decisions based on where things are going over the rest of the year.
Right. Yeah, no, absolutely. I think it's good to keep it in context. Because right now there's just a lot of disruption, and I don't think a lot of folks have a really good sense of exactly how, that some of these things like tariffs are going to impact their business. In each sector is a little bit different too, right? I mean, you get each and every single day or each and every single week, somebody gets exempt, some industry gets exempt. So like tariffs is one that's always, well publicized and very fluid, is a great example. I think in large part, though, in terms of, the M&A environment, I still think there's a lot of, there's a decent amount of activity, right? I mean, I think as of late, a lot of transactions have sort of, I guess, elongated as people try to figure out what the ramifications are to certain business, but that doesn't necessarily mean it's going to kill transactions. I think people just kind of have to say, okay, let's digest this data, and let's figure out how we need to think about pricing or underwriting, with these sort of risks in mind. And I just think that overall, for the rest of the calendar year, I still think there's a lot of bullish activity in the M&A markets. I think the financing markets have improved, which helped.
I saw that. So I want you to double click on that for everybody. So like what's changing in the financing markets, and like how does that translate into deals, valuations, deal structures?
Yeah, so for one, the cost of money, interest rates basically are getting less expensive, which is good. Obviously, some of that is because we saw the Federal Reserve obviously lower interest rates in the third and fourth quarter of calendar year 2024. I think the expectation, hopefully, is that there will be more to come. But as of now, I think the Fed's kind of hit the pause button. But nevertheless, as a result of what they did do at the end of last year, that means interest rates have come down a little bit. The second thing that's happening is I think we're seeing a increase in the amount of leverage that lenders are willing to lend on a business, right? So there's a little bit more availability in terms of how much debt and the appetite, yeah, I guess, in terms of how aggressive lenders are willing to be. I think if you have an above average performing business, there's still a market for your company out there, right?
A
I
big
mean,
market, right? And there's a
big
lot of
market.
people that want it. Yeah.
Yeah, a big market, and you'll see that reflected in your valuation, your pricing, right, for your business. And I think you'll see that in the availability of debt, as well as the cost of debt.
hmm
You
hmm
should get much more favorable sort of responses from the marketplace in all of those categories if you're an above average performing business relative to if you are a below average performing business.
hmm
It's one of these environments right now where if you're a really strong, good, best performer, you're still going to command a lot of interest.
Because the lenders want to lend, buyers want to buy. PE needs to deploy their money, and so kind of two different follow-up questions for that are slightly different. But I want to get to back. I'll start. Just put a pin in the what does a premium mean? What does best performing look like for you? I want to unpack that a little bit for the audience. But then before lenders, do you see these increases in appetite coming from any particular sector? Because as Alan and I were talking about, there's a lot of toxic debt sitting on a lot of these middle market banks.
Mhm.
And so are you seeing different size banks or different types of banks that are willing and have a bigger appetite? And where is that appetite being driven from?
Yeah. I think there is some interesting dynamics within the lending community. Remember, if you kind of take a step back, when I think about the lending community, I think about the fact that there's this traditional sort of bank market, right? That's the lending community that's been around in this country for 100 plus years, right? Very regulated. Those are going to be your big banks, national banks, your regional banks, even your local banks, right? And those are banks that traditionally be, sort of pretty, pretty conservative, right?
Mm-hmm.
And going to be lending in a very sort of narrow box a lot of times.
A lot of real estate, and I think that's where like a lot of the real estate exposure is sitting with the low
Exactly.
interest rate loans that they gave for a lot of
Exactly.
years.
I
Yeah.
think when you look at those banks, exactly, they have some exposure to commercial real estate, and obviously they're keeping a close eye on that, and that might impact some of the parameters, that they can lend into in future situations. They also tend to have a lot of perhaps some concentration in particular industries. There's one bank that we know real well that has a really strong metals practice. In the last several months, the steel producers have has had some tough times.
Yeah.
That could change
I got
with
some
some things.
clients in the space. So yeah, it's
Yeah, that
yeah.
could change with some things going forward as a result of tariffs. But there's just been a really tough operating environment in 24, particularly companies that are involved domestically here in steel production. And so I know that a lot of the banks that have a strong, that are metals focused banks that have a
hmm
lot of exposure to a large variety of steel producers are
hmm
probably not looking to add to their portfolios anytime, and are probably
hmm
keeping a really critical eye right now about, the performance of some of the companies in their portfolio. So what we're really sort of seeing is the second market, right? That when I think of the lending community, which is the non-bank market, right?
Right.
This is the newer market in the US here that's really sort of proliferated in the last, call it, 10 years.
hmm
A
hmm
lot of the credit funds, it's business development corporations, it's things like funds that have been established by certain financial sponsors specifically for lending, more traditional type lending or a more exotic type lending. They're not regulated by the same sort of dynamics as the bank market. They can be more flexible. They can offer less in terms of amortization schedules up front and sort of back end load a lot of the amortization to give a little flexibility in the near term.
For the cash flow, giving people some breathing room to get the deal done.
More of a cash flow based lending type,
what a concept.
Yeah, instead of just assets. So, it's like, and there's a lot of dry powder there, right? And
right.
lenders, they still have to put capital to work. So regardless of what's going on, they're sitting there saying, well, I still need to find a home for this dry powder. And when something, is attractive, it's going to be attractive to a lot of people, which is good if you're a company looking to borrow money, or if you're somebody that's trying to finance a transaction for a really good business with great attributes and good obviously growth.
Those private debt markets have become fascinating to me. I've interviewed this guy named Richard Wilson, who is the head of the Billionaire Family Office Club. And they have he's the Family Office Association for family offices. And it's all about, deploying money and getting a return anywhere. And so they've got a lot of people that have gotten into the markets that you're talking about, where they want a 10-15% rate of return on money. And if they can do that through doing debt, they're filling that. And it's so fascinating, Jeff, because even though, you get into the lower market where you're talking $1 million normalized EBITDA, and this is one of the things I wanted to talk to you too. And we'll go back to the premiums, and it's all kind of tied together where there's just such a no man's land between, they call it $1 million to $3 million in normalized EBITDA. And you go to traditional banks and they're looking for assets, not cash flow. And just the whole thing is such a bad conundrum, I think. But I think it's so important, what you and I talked on, a couple months ago about the different types of buyers and the deal structures. Finding someone like you who can put this jigsaw puzzle together is so damn important, because who's lending, where are they lending to? It doesn't mean that the person doesn't have a good company. There's just all these other market factors going on that might impact the deal to get done. And it becomes a lot. Your job becomes more difficult and or more valuable, I think, probably at once.
Absolutely. Yeah, no, for sure. It's times like these when things are more challenging for a variety of reasons, where, you really have to explore all the options and make sure
you're not just listening to one bank, right?
Yeah,
it's the bank doesn't want to lend. It's that's not the answer we're looking for. So we're going to go find a different answer.
Exactly. Right. Yeah. For sure.
So one of the things that kind of tied into this, the lending, the lending market, which is, and the debt load that people are willing to put on it, it goes back to with my clients, where I'm regardless of whether you want to sell or not, understanding your numbers of what you want for free cash flow and what you want as net proceeds at closing, then you stack on all the other potential deal structures on top of that. The more of a premium you can yield, the more bankable you are, and the more all of that then yields to more cash at closing. So in the data that you guys send over, you talk a lot about financial premiums and management, but let me give you just my take on what that means. I'm curious on what your take is, Jeff. So what I'm constantly trying to help people see is the more they can explain in the past, they were predicting the future with their financial forecast, and they were showing budget to actual. They're going to get more credit for the future because they've proven the past, and then therefore the bank and the buyer will believe that their story more, which means they can get more cash at closing, whether it's a combination of debt or equity. But that kind of yields into your premium and the different things that help. What would be your definition if you're representing someone that has the highest potential to get as much cash at closing? What is it that you're looking for?
Well, certainly a good track record of financial performance, number one, right? It's has the company been growing, or has the company been declining, right? Or not growing at all and just stabilizing. I think that's the first thing. If you can demonstrate a good track record historically of growth over several quarters or several years, then that's going to aid your outcome. I think the other piece of it too, particularly in the context of trying to go out and sell your business, is to demonstrate that if you're planning to step back from your business, that you've got a good leadership team that's going to be staying behind, right? And
I saw the premiums are up on those. Right? Yeah. People are really excited about that.
Yeah, exactly. And to the extent you don't have that, what that essentially means is that some buyer is going to have to come in and invest in that team. And if they have to invest in that team and fix it up, that's going to impact your pricing at close. It's just you think about a house, right? If a house is completely done, someone did all the renovation work, before you're thinking about buying the home, that's going to be different than if it's a total, big renovation job. You're going to factor that in the price for your house, right? Same deal with buyers of businesses. If they don't have if you've got it already cleaned up and it's ready to go and it's just rocking and rolling, that's an easier lift for someone to step into than if they need to invest in a new leadership team. And some of that then bears fruit in the things like, your financial performance, right? And also in your margin profile, because, companies that have really good margin profiles are going to be attractive, to buyers and lenders, as you might imagine, because it just shows that, a business, number one, is performing, but number two, a big part of the math, of course, the equation going forward is being able to meet your fixed charges being on any debt that you put on the business on a go forward basis. So the better the margin profile, the more, you comfortably you might be able to meet your principal and interest payments as they come due, and maybe even support that much more debt, on a business, which again, can be important for financial buyers, perhaps more so than strategic buyers. But nevertheless, it's those types of things that when you demonstrate all of these things collectively, and you happen to be in an industry or a space that is really attractive to somebody right now, they all add up to kind of that premium type experience.
Well, it all totally makes sense. And one thing I'm curious on, I mean, it might be just such table stakes for you that I want to hear your opinion on it, is like the cleanliness of the financials and then the actual planning. So then obviously, not obviously, but I mean, it's a good call out of like the margin, the price performance and all that stuff. But then like, does someone believe the numbers? Right. And have you been, because like the reason I'm bringing this up, Jeff, is like, so many of my clients, I mean, they'll take it personally that they're down. I'm like, well, the money hasn't been printing over the last, 18 months. And now we've got cuts coming on and tariffs. So there's a lot of this stuff, but like, I'm just such a believer that if the story makes sense, you could potentially overcome that. And the story is just in the financials. And so like, maybe give me your takes on like, yeah, there are tariffs and there are different, industries. And I want that kind of ties into the question I've got about industries and sectors that you see are attractive right now. But like, there's a lot of things that are not equal across the board, right? But if the story can be told, I feel like some of that stuff can be overcome if it is a good company.
Yeah, absolutely. Yeah, no, I think that's exactly right. I mean, I think that's the important thing, is being able to reasonably explain the story in a way that someone who's coming in from the outside that doesn't have the history of knowing the business can understand, right, and get their arms around. Right? Is it a believable story? Does it make a lot of sense? The challenge is these situations where, you have an industry, let's say, for example, that's performing, and then you have a business within that industry that's performing inconsistently with the 9 or 10 other companies that somebody has been reviewing, right? Whether it's a lender or an investor. They're sitting there saying, well, every other company that I've looked at seems to be doing fine, but you're not. And so
why?
And that's more isolated to the business, and that's a harder story, right? But again, can you overcome that? Perhaps, if you've got a really good reason you can point to. But those are the situations where you think about your own business, but you got to remember, like, someone coming in that's a third party,
what are the comps?
Business from the outside. You're not the only business they've seen in the industry. They've seen 100 of them. So they have an idea already in their minds about what they think they're going to see, because they know that you are a business in this space. And 90% of the time, every time I've looked at these businesses, they all have margins of X and they all have growth profile Y. And this is what I expect to see. And if I see that, great. It's an easy story to, kind of nuance.
Reconcile. Yep.
To reconcile. But if I see something that's inconsistent with what I expect to see, then it becomes really more of a challenge to kind of tell that story, to really explain to someone, because they are going to look at it with a skeptical eye and wonder what's going on here.
And the same holds true, even if the entire sector's down because of normal business cycle stuff like ITR talks about. It's just, are they relatively all down? And this one's less down than the others. That actually might be even more attractive. But I think what's back to even what you're saying, like, I've got really good companies as clients, I'd say, and like they hold themselves to such high standards, they get so down on themselves. I'm like, no, like, if you compare yourself and this is normal, it's actually like it's the story still makes sense to buyers.
Totally. Yeah. I mean, that is a systemic issue, right? So if the whole industry's down and you're not down as much as everybody else, that says a lot too, right? So that's another story that, again, you might have some challenges timing wise, just because the industry sort of cycled down for a moment.
Mm-hmm.
But if someone's looking backwards, knowing that this cycle existed, say 18 months ago, and they know, hey, everybody in that industry was on a down cycle and everybody was struggling, but you didn't struggle as much. That is a testament to the leadership team or the business
Yep.
management, and that's just as important as
And
performing.
the testament of why it's so damn important to have an investment banker representing you, because if you can't tell that story, someone's going to use that story against you. And if you don't understand the context, then you might take full responsibility over something that's systemic, and you shouldn't have to, because it's just a kind of the asymmetric information. And like, I'm curious on the buyers, Jeff. Strategic buyers, private equity firms, where are they, what industries and sectors are they liking, given the fact that tariffs are coming at, varying degrees of industries? And then also, with how much exposure the economy has to money, to the government printing, the potential ramifications of Doge. We haven't seen a lot of this. I mean, I've got a client right now where like they're seeing a lot of available people coming to market that they're excited about, because they're like, hey, they're not competing with the government as an actual employer now. So now they've got like talent that's off the charts. So like there's a lot of mixed signals within that. So like, what's kind of the narratives that you're seeing as far as like buyers looking at those types of dynamics when they're looking at buying companies?
Yeah, I think, industry wise, there's still, I think from a strategic perspective, there's still a lot of interest in manufacturing companies, right? People that are that are strategic buyers, they want to make an acquisition because it's an important part of the growth strategy going forward. They don't just want to grow inorganically, but they want to. They made a more of a concerted effort at the board level, perhaps, to make acquisitions a part of their growth strategy, and that's because they want to manufacture, whatever products they currently do, but they want to maybe bolster their number of SKUs, or they want to, maybe they have a wide variety of SKUs they manufacture, and there's one that a little bit they manufacture less than the rest. It's not a core competency. They want to bolster that, right? This is an opportunity, I think, for strategic buyers to think about making acquisitions in the manufacturing space. So I think I think we are seeing some of that. I think, in terms of another industry where there's still a lot of interest is still in companies that have an opportunity to have exposure to infrastructure. I mean, we have an aging infrastructure system that's not changing.
Yeah, right. It doesn't matter what you say. You still need stuff there.
Yeah, the federal government still has, a significant amount of dollars committed to improving the infrastructure, and that trickles down to the states and the municipal level. And I think there's still a lot of investors that want to have exposure to that. And there's a lot of interest in finding those companies where that's the case.
Which is so fascinating, Jeff, because like I was even talking to one of my clients, I'm like, that infrastructure has a wide variety of industries that touch it, from distribution to services to manufacturing. I mean, it's like in all those different types of businesses, you can still get exposure into that infrastructure spend. And it could be as part of someone's strategic planning to say, like, with all this rockiness all over the place, here's something that could be a little bit more predictable.
Right. Yeah, that's right. That's exactly right. Well, at least, I don't know if it's always predictable as much as, anything can be, but I think what people like is the fact that there's this commitment of large dollars.
Right.
And there's obviously a deferred need in, a lot of states.
We can't not do it after some point is kind of the point, right? It's like we still need to do this regardless of how political things might get. Like we still need to upgrade the infrastructure.
Yeah. And there's obviously there's areas of the country that continue to grow, right? I mean, you see things continuing to, the economy continuing to be very, very strong in states like Texas, where you have a lot of companies that are moving their headquarters, and you have a lot of people moving there as a result of that. And so, you're going to need home construction and roads, and you're going to have site development prep, and you're going to have, pipes for plumbing and water and everything else. And so it is also regionalized. And I think depending upon where you're located as it relates to infrastructure, that'll also have an impact.
I think it's just such important for people to start integrating these ideas into their strategic planning instead of just, marching forward with, arbitrary goals. And how are buyers looking at suppliers and exposure to different, countries with tariffs. I mean, because like I got a client and friend. He's extremely happy that he's getting a bunch of shit from Indonesia because all of his competitors are getting it from China, and he's like, "Whoa, sweet!" And so like that wasn't necessarily intentional, but like I mean, so like how are buyers, diligently or like deliberately going through and analyzing supply chains?
So I think the jury's still out a little bit because it's number one, new, and number two, ever changing by, it seems like, every other day. There's like new news coming out or new information coming out about the administration and kind of what they're going to do with tariffs and what industries might be carved out. I think automotive was just carved out like last week, right? So prior to that, everybody was thinking something different about the automotive industry. So the jury's still out a little bit, but I will say this. I think there are a lot of manufacturing businesses that are looking at the global supply chain with a more critical eye now, pertaining to where those materials are sourced. And I know we're working with a client right now who sources a lot of its goods that is coming out of China, and as a result of that, knowing potentially that there's obviously and has been announcements that there's going to be specifically tariffs on China, they themselves are thinking about moving their supply chain to Vietnam, right? And they've already established and have been talking about it for a while, a little bit, but never really kicked the tires. And now they really ramped that up, right? They really ramped up those discussions, going, okay, we have some really nascent relationships in Vietnam, but we need to really sort of double down on that and really maybe put some of these wheels into motion in the near term here, if this is something that's going to be a point of emphasis for the administration for the next 4 years.
Yep.
And shift obviously the manufacturing to a different foreign country to give themselves a competitive advantage in terms of cost structure.
What I find so fascinating about a strategic move in that space or in that vein is that someone that, knowing that, like, back to even how you were talking about the infrastructure, like none of this is guaranteed to be predictable, but like there are big trends that I think we can continue to anticipate, like the China tensions, right? I mean, there are certain countries and certain places that are going to be kind of like where there's just a general move away from them. And I think about like the middle market. It's like, hey, if you already have relationships in Vietnam or Indonesia or some other place like that, so that person that you're talking about can either expand like that, or like they can buy a company to buy the relationships and buy the supply chain, right? So there becomes a very interesting move to be played if you're looking at 1 to 3 years out of selling. It's like, hey, there's a general trend here, and if I've already kind of got some foothold into this, doubling down on that might be worthwhile.
No, that's a great point. I mean, I think that in today, in the environment we're living in, if you are a company that's U.S. based and you're manufacturing something that for a while has been offshored, right? The math changes, and hopefully that means maybe you're going to be in a much, much stronger and better position to gain some new customers, because whomever was sourcing goods out of China, they might say, you know what, the math is such that now I could just source it from a U.S. company. Maybe it's not quite as significantly more expensive. Maybe the delta has shrunk quite a bit. And now I get this, much closer vendor to provide me the goods. I don't have to wait for goods to come over on a big, barge in a big container, right? I can source it from a domestic based, business, which some folks might benefit from significantly, right? Because they're in a much, much better position now than maybe they were, 8 months ago.
How are buyers in different, the different types of buyers that you're thinking of or that you're working with have thoughts on AI? And not to be some like, out pie in the sky, but I'm just like, when I'm looking at the boots on the ground, Jeff, of like what myself and some of my clients are dealing with, it's like analyze. So like, I'm just riffing here for a second, but like, okay, like there was a company that just redesigned DocuSign in 2 days. Well, that should somehow translate into DocuSign's price at some point, because the risk is maybe the risk premium and the valuation. So like there's this whole SaaS community. I don't play a lot in SaaS, Jeff, but like, I mean, I've got friends in it and I've got friends that have raised funds, and I'm going, man, I would be slightly stressed out knowing that like there's a whole dynamic here. But then even on the traditional businesses, Jeff, when I look at like, so this is how my brain is working. And like, I want you to know if I'm on track or off track. But like, I mean, like, okay, if you start extrapolating AI and like how fast this is going, I'm like, okay, well, technically, like from a very like literal perspective, revenue on the income statement is the value of the goods or services that you're providing to a client.
Yep.
Then cost of goods and overhead, the literal words are costs and overhead. And so all of that junk inside of your income statement should be looked at in a different lens to say, how do we automate HR processes, operation processes, legal processes, you know, all of this stuff.
Yeah.
Like, are there buyers that are like having a lens to say like, you know, there's the traditional model of what I'm looking at for a purchase, but like, is there anybody that you see that are integrating like AI plays and like looking at different post acquisition, like how they might be able to treat the business a little bit differently?
I think there probably is. Yeah. I think there's a, you know, a different perception for how AI can be used by industry. And I think the jury's, again, still a little bit out on kind of how AI can be utilized to its fullest extent. I mean, I probably, like you know, played around with it on online here, and it's amazing, right? And I think it, in a lot of ways, it blows people's minds, like what you can possibly do. And I think that people, as every, you know, sort of month goes by, I think everybody starts to think about different ways they could use AI in a particular industry. And I'm sure, you know, you think about industries that are in the professional services, you know, sort of space.
That was one that came to mind too. Yeah.
Yeah, I think those are the ones that are probably more likely to be thinking about how we can streamline, you know, the amount of
payroll's their biggest expense
using AI, because payroll's their biggest expense for sure. And I think, you know, it's something that will continue to evolve. But I think those are just like anything else. You get buyers that think, okay, if I had this business in my cost structure, where can I wring out some expenses, right? And if they're familiar with wringing out expenses through the use of AI, then that's absolutely one of the things that they will be a lever that they will pull on a post-transaction basis. I think it's still a little bit in its infancy stage. But
it'd be interesting over time if you see, and we should have this as just kind of a check-in data point as we continue our episodes. We're like, does it come from the bottom up where it's companies? Because like, here's what I'm seeing is like, I can implement this stuff at lightning speed because I don't have a huge infrastructure, right? But then you have like my friend who's got he's a upward senior management at a $400 million professional services firm. And I'm listening to what he does. I'm like, you could cut half the shit out of your company. But it's like, well, this meeting for that meeting and this meeting for that meeting. I'm like, you're just like, so will it be people where like that company buys someone else that already has it all implemented so they can bolt it on? Or will they be the ones, it's probably coming from the bottom up to some extent, but then those companies will have a premium because then they've already kind of with the supply chain, they've accelerated the path towards something.
Yeah, I don't think we've seen quite yet target companies that have like the whole AI thing figured out seamlessly. Right.
Well, I don't think anybody's got to figure it out. Exactly. That's probably why, right?
So I don't know that any buyers are looking at that going, oh, I like what you've done with AI already. I'm going to implement it on my platform, right? I think everybody's still just, you know, kind of figuring out, and no one's that far ahead.
Yeah, fair enough. We've covered quite a bit. The one thing that I was going to ask you, so I got a friend in private equity. He's done like multiple billions of dollars. He's now in the coaching world as well. And he was saying that in the private, because we were having a conversation about like, you know, the interest costs. And I think on your and I's last conversation, we talked about, well, like that's a fixed cost. So like the other lever that has to move is revenue. And then depending on like what's going on in the economy, I mean, there's some pinch points happening for some of these these portfolios. And he said that some of the PE firms that he goes, PE firms going through an evolution was his kind of way of wording it. And he said that some of the people that he knows are talking where like they used to model out 8 out of 10 portfolio companies working, and they're kind of reducing that down to 2, 3 out of 10, and just trying to be a little bit more realistic for the returns that they have to deliver. I don't know if that's, I mean, anecdotal, very anecdotal, but like, I'm curious if you heard any conversations around how the returns are still going to be met given some of the turmoil that we're going through.
Yeah. I mean, that's always a challenge, right? And I think that you know, the other piece that's challenging is the labor side of the equation. I think that companies are still dealing with, you know, sort of inflationary labor environment for a variety of reasons. To your point earlier, you know, maybe with Doge, at least at the federal level, particularly for like some government contractors, they might find a large universe of labor now that's available that maybe wasn't previously available. But I think in large part, we still see companies struggling to find talent, and trying to manage some of the inflationary dynamics in the labor piece. And so if you're a private equity firm, there's a few levers you can pull. And I think they're trying to be really smart about what's a realistic lever this day and age, because of the fact that you still have, pretty elevated costs for debt, right?
Mm-hmm,
And
mm-hmm,
if that comes down, that's going to make things a little bit easier.
mm-hmm.
But I don't know that that's the cost of debt's going to come down significantly quickly in the next,
Yeah, value growth
month.
and actual free cash flow is kind
Yeah.
of the name of the game. Well,
Yeah.
I'm curious on that labor front. Given the next 5 years of 30 million boomers retiring, and on top of a labor shortage already, I've got some clients and I've come across some really unique strategies that people have started to deploy on how to recruit people and talent management itself. A couple, fairly significant companies, call it 50, 60 million bucks, where like they have an apprenticeship program and they've created a nonprofit where they're creating a certification in their industry. But like is that something that the buyers are thinking about, or any of your clients that you're like, hey, like do we have a talent recruiting and management process? I feel like that could probably help with a premium too.
Yeah, absolutely. I mean, everybody's talking about retaining employees and attracting new employees, right? I mean, and the retaining piece is the harder part, because it seems, we talked to some clients that they feel like in their industry, everybody's just trading employees every so often, right?
I feel like that's
So like if you can
it.
show like, lower turnover
Yeah.
than like other companies in the industry, that's another one of those characteristics that can help point to like a more of a premium type valuation relative to others in the space, because it's so disruptive if you have a lot of turnover, right? And
Mm-hmm.
you can hang on to that talent, then that means you should be able to operate more efficiently, and hopefully again it demonstrates that in the numbers, whether it's top line revenue growth or margin profile, right?
Mm-hmm.
That efficiencies from that
Yeah.
experienced workforce. You're not having to
Yeah,
train
right.
downtime, and utilization's down, and things like this, because you've
Yep.
got so much like
Your
down
output's still up.
trying to get people up to speed.
This has been super fun. I covered, I think, quite a few of my topics. Anything that we didn't cover that you think is worth noting?
I don't think so. I think it'll be an interesting another,
We'll have more to talk about.
We're almost at the end of Q1. So, I think Q2 will be interesting. I think it'll be a little bit more of the same, but I feel like I'm hopeful that there'll be some improvement in a number of forces, right? I'm hopeful that the lending markets will continue to improve. Rates will come down a little bit. Perhaps we'll see some more favorable movement or digestion at the tariff level. And I think hopefully we'll see some improvements maybe in some of the underlying inflation dynamics in labor, so that companies will start to experience maybe a little bit margin expansion, rather than focusing on how do we mitigate and minimize margin compression.
Well, I like that a lot, and I hope that's the truth too.
Yeah.
One thing that it'd be interesting as we catch up next time is with how much debt the U.S. government has to refinance. And like I talked about this with Alan, where like the rates are coming down on the 10-year, from what I've gathered, because we're trying to do the hard stuff. And because even though the Fed reduces rates, it doesn't mean that the lending reduces rates, because if the whole world doesn't think that we can service the debt, we've got $9 trillion we have to refinance this year. That's a problem. And like, that's going to impact the lending, and it's going to impact the banks. So like, I think it'd be interesting as we follow this, like, how does that, like, hopefully that's all the case, because just because the Fed reduces rates doesn't mean that the lenders, but that's back to then like you and your role of trying to find the people that are still having that appetite to lend is going to be, I think it'll be more of a necessary skill set that like people like you and ButcherJoseph have, because it's going to be not as obvious, in my opinion.
Yeah. I mean, you have to, obviously, you hit on a good point. I mean, rates coming down in and of itself doesn't mean everything's rosy. It could be coming down because, we need to spur macroeconomic, activity, and things are not great. And so, And so that's where you see a dynamic where if pricing comes down at the Federal Reserve level, there might be a lag in the lending community because the lending community might look at this and say, okay, well, there's still some elements of risk out there, and I need to price in these elements of risk, and so my lending rates might stay elevated longer. If the reason the rates are coming down is because we're, say, in a depression, which I'm not suggesting anyone's thinking that, but you see my point illustrative.
Yeah, totally. Yeah, totally. And all indicators show that we're on the upside of the M2 money supply growth, which is a good thing, hence the ITR forecast and stuff. Always fun, Jeff. I appreciate your time. Yeah, it's great. Go to ButcherJoseph.com. You guys got links we got in there. You got a bunch of good material and a bunch of white papers. And I have pushed a couple people to you where if people want to understand, like, and maybe this is if you got an extra minute, is like the value that I've seen in our, like, just what ButcherJoseph does is you have the ability, because you do ESOPs, private equity, third-party sales, management recaps, it doesn't matter. And you can help people see the difference of the pricing and the deal structure, comparing the different options, which I have that kind of context, I think is super valuable.
Yep. Yeah, exactly. Show them all the different options, door number 1, 2, and 3, and pros and cons of each, and hope you pick your poison.
Hopefully the poison comes with a big wire. Jeff, thank you so much for coming back on.
Thanks for having me, Ryan.
That was fun. All good stuff. Joe, like, the time is money. And and that's why when I started watching your YouTube channel, man, it's just like, it's so clearly articulating how all these complicated stuff, the things that you're talking about all the time, it's really, at the end of the day, it's just stealing our time.
Yeah.
And then you have all these people that are making bets on their time and how they manage their investments, how they manage their companies. And it's like, well, we have to understand how the game is really played if we're going to place our bets of time accordingly. And when I was really excited when you said that you were willing to jump on for these quarterlies, because the people listening in are owner operators and they're trying to be capital allocators and understand how their business is going to be impacted on this, and understanding the mechanics of what's going on in the day to day. And especially because of what's going on behind the scenes, well, not even behind the scenes anymore. It's all front and center with all this stuff that's going on. How does it impact their bets to sell the company, to reinvest the company? What's my rate of return? And you've done such a great job, man, on, like, having kind of the play-by-play, almost like a sports commentator, but like, what's going on with the Fed, what's going on with the Treasury? So how does this impact it? So anyways, that being said, I appreciate it so much, you coming on.
Yeah. Well, I'm always glad to come on. And I think another thing, I don't know if this is too unrelated, but it's something that people don't think about enough, is like when to kind of cash in. Because when you think about, money being time, and building businesses and saving and investing, so you can get that back, you at some point you actually have to use it. And so, like, you imagine the person who's a miser and works and saves their entire life, and really never spends any of it. And, I knew somebody like this. I literally, I started a job, and that week somebody else had quit. And 2 weeks later, we heard that, he had started going to travel with his wife. He was 65. He had just retired. He dropped dead 2 weeks later.
No, I've heard that.
So
a lot.
it's like, it's a common thing. People work their whole lives, they save their whole lives, and then they die. And it's like, okay, well, you died with, let's say, $3 million in the bank. That's $3 million worth of your time that you had to spend to get there, and then you didn't get to actually use. So
yeah, totally, man. Yeah. Totally. It's like, you ever seen that Justin Timberlake show where he's got the time clock on his forearm? Yeah. I mean, it's such a wild, like, that's a digression, but very fascinating. And I think it's like, what I'm like, why I like following your videos, and why I want to get into some, I've got, a handful of questions here, and you've probably got some topics that you want to talk about it and the data, but like, why it's so important is, if you're going to make your bets, understand how your bets of time are going to pay off or not. And if someone is pulling the rug out from underneath you along the way, like, just use that as the context to say, okay, what should I be doing? And like, back to your $3 million, it's like, what I'm trying to do for people is, like, how do you optimize your time? And you need your cash flow not tied to your time. So through distributions from ownership, not necessarily from your W-2 or from other assets, or maybe there's sound money that actually preserves your time. Well, what a concept, right? And so, like, but all of those dynamics that you're looking at, I think, are bringing it in a digestible way. And so, like, for what we want to cover today is I've got questions about things that are going on. And I don't know if you want to start with certain things about what you're paying attention to, because things are happening fast. And if we're going to be doing these every 90 days, you haven't committed to that, but like I think it would be interesting of just because it's so relevant to pay attention to this stuff, and it's so confusing when every media publication has a specific angle that they're trying to get at, and what really is the truth, I think, is what you're doing a very good job at.
Let's start off with some of the questions that you have prepared, and then we'll kind of go off. We'll go off from there.
Okay, so lots obviously going on with Doge and the cutting. There's obviously a lot of tariffs going on. There's a lot of the stuff that everybody's really following with the headlines around Twitter, whatever it might be. But the 10-year treasury, you just did a really good video on that, and I've been following that too. And like maybe talking about why the 10-year treasury is important, because even though the Fed has reduced rates, treasury has gone up. And so like maybe just, I think part of this, I think, can be, updates, but then also some education of why these KPI, or not KPIs, but why these pieces of information are important to you and in the grand scheme of things.
Yeah. Okay. So the largest issuer of debt in the world is that's going to be the financial bedrock. It's going to be the bedrock of the financial system when you look at the debt that the United States issues to the rest of the world, whoever wants to lend them money. It is considered risk-free because at the end of the day, the United States has a domestic monopoly on violence, and they are able to use men with guns and force in order to get the money that they need in order to pay back their bonds. And so that is why governments have a lower interest rate on their debt than private citizens, because you can loan money to Amazon, but they have risk of default because Amazon can't put you in jail if you don't if you don't buy their products. So at the end of the day, a monopoly only exists with
why do we pay taxes? Because you will go to jail.
Right, exactly. Yeah. Monopolies only exist if there's violence behind it. And so you have government sanctioned monopolies like internet service providers, where it's like the government is saying, hey, these are the only people who can provide this service for you. That's still a monopoly. But in the free market, you don't have that, because there's always the risk of competition. And so with a lender, that means that they have a lower interest rate because they can always do whatever they need to get that money back, even if that means printing to pay back the lenders. All right, so that is the foundation.
When the interest rate, comment there too, because like when I've been talking for the last, call it like 3 months, about deep dives into weighted average cost of capital, the discounted cash flow, because we need to think about that as a company. The risk-free rate is the first level of the buildup of the weighted average cost of capital. So it's like this whole topic has become so important, because it's like and I always joke, that's the risk-free rate, right? But like there's the money supply growth that impacts that risk-free rate. But like to your point, there's a bunch of people lending money to the government, and that rate becomes what everybody's giving, or the rates that are required to lend to the US.
Right. That is the baseline. And so when you look at private lenders, they're going to require private debtors, they're going to have to offer a higher interest rate in order to attract lenders. Let's say the 10-year yield is 4%. That means if I want to put my money somewhere where I don't have to assume any risk, I will loan it to the US government. Maybe I don't actually exceed inflation, but at least I know I'm going to get my money plus interest back. And it'll kind of, maybe chug along a little bit. And so if I'm going to go to you and lend you my money instead, I might need 5% because you have a risk of default. I might not get my money back. And so whatever the US the US government is borrowing at, that means everybody else has to, their cost of debt is going to be higher than that. And that ranges from the type of debt, the collateral behind it, the borrower. So like corporations versus individuals, credit card debt versus auto loan debt. So all of these things will have different levels of risk that the lender is going to tack on a higher interest rate to compensate for that higher risk. The 10-year specifically is a really good benchmark to look at, because so many other forms of debt are right around a 10-year maturity. So when you look at mortgages, they're 30 years, but very few people actually let their mortgage go for 30 years. Many times people are refinancing. Many times people are moving and getting a new mortgage. And so it's around 10 years is the average length of time before a mortgage that gets created gets paid off from either a refinance or a sale or something. An auto loans these days are getting up pretty much near 10 years.
82 months,
Yep.
baby.
Yep.
Oh my God.
Yeah. Corporate bonds. So you have all of this debt that is like the average length of maturity is in that neighborhood. And so sometimes it's a little bit less, sometimes it's a little bit more, but the 10-year provides a very good benchmark of where all of the other interest rates in the system lie. And so when you look at the economy overall, the classic economic view is, okay, well, if interest rates are lower, then that stimulates economic activity. How in depth do you want me to go on this?
Because it depends. Honestly, it depends on how much time you want to riff on this. Because maybe before you continue, here's what I'm looking at, Joe. Because I don't get to talk to a lot of people besides you, and God bless you, Aaron Street, who's probably listening in. And there's like my 5 people that I force feed you and all this topics is the context of what's going on with tariffs and with Doge and all these different things are impacting the rate that has to be paid. We have $9 trillion to refinance as a country this year.
Yeah.
Right. And so there's this balloon payment coming along with all the commercial real estate and then all of the zombie bonds in the public markets. And we don't have any data on private equity, but it's like, I keep saying to everybody, there's this huge lump of money that has to be refinanced right now. And what's impacting it is how many people want to lend us money and at what rate they're willing to lend us money, because it's not just the Fed rate. So we have to borrow. And it's and you get into a lot of we can reference a lot of these other videos, but you did a good job in your video honing in on the 10 years, what people are what is being focused on right now. And there's other collateral damage of the stock market and all these other things. So that's where I want you to correct me, describe a little bit more of on track, off track.
Yeah. Okay. So it used to be people paid attention to, and it used to be probably before about 3 years ago, the most important thing to pay attention to was the federal funds rate. Because the rest of the yield curve would kind of follow that. So if the Federal Reserve lowered the federal funds rate, then that means that banks don't make as much money there. And so they're forced to put that money out into the wider economy. But once inflation escapes and starts, and prices start going up, then the rules of the game kind of change. So if the federal funds rate goes down, and then people expect, okay, well, that's going to mean banks are going to be lending elsewhere instead in order to get the return that they're looking for. That means businesses and people will have more spending capacity. That's going to drive prices up. So me as a private lender, if I'm going to offer you a loan, I'm going to require a higher interest rate now, because over the next 10 years, prices are going to go up now because there's more money being injected into the system that wasn't there before. And so that's why when the Fed lowered rates, the 10-year yield went up. And so the Trump administration right now is focusing on what can we do to get the 10-year yield lower, because they also are under the assumption that, hey, if we get interest rates lower, economic activity booms because people start borrowing and spending more. And so the path that they are trying to attack this with is lowering government spending, lowering taxes, and tariffs. And there's a lot of flaws with the way that they're approaching this.
Quote, asterisks on tariffs.
Yeah.
Right.
Yeah, a lot of flaws with the approach, but that seems to be the goal, based on what they've said and what they are currently doing. And so that's why they're trying to get the 10-year yield down. Hasn't really gone down that much, but it could, at least for the short term, dip significantly lower.
And I just think about, and this is where I know my brain spider webs into all these things, but in my head, it's like the Matrix, I could see it all, but what order do we take these in? So we're going to have to refinance and we're going to have to borrow this money to pay off, or to at least do something with it, because it's due this year in a lot of different sectors. And then you've had some good segments about potential ways the banking sector will absorb this versus
where the money will actually come from.
Where the money that's one question. And then maybe two is I have been hammering home and trying to, as I've learned over the last couple of years, Joe, is that M2 money supply growth is something really important to look at. And I actually built out this this spreadsheet from 2005 to 2025 the exact column of every single year, the M2 money supply growth, and if your money compounded on that or if it eroded at that. So if
Yeah.
it compounded 100 grand would need to be 332,000, or if you eroded, it would be 23,000. So maybe like talk about M2 money supply. Do you think this is a good order of like talk about what M2 money supply is, and then the implications of the money getting put into the system and how that impacts asset prices?
Yeah. Okay. So money supply growth in a vacuum, I'll talk about first, and then talk about that there's other things that impact prices beyond the money supply, and then where the money is going to come from to refinance.
Okay, I like it.
So in a vacuum, in other words, an evenly rotating economy where there's no extra production of goods and services, it's just, the resources that we have, and it's just everything's getting swapped around, which that's not reality. I'm just using this to explain. If the money supply increases, then you have more money chasing the same amount of goods and services, which means by definition, prices have to adjust higher to compensate for the extra purchasing power. And so
the denominator is bigger.
Exactly.
Right? The denominator.
Exactly. A really good way to visualize this is to look at a stock split. When you have a stock that's, trading at $1,000, and then you have, let's say, 10 shares. They do a 10-for-1 stock split. The price goes down to $100 per share. But now you have how many? You had 10 shares before, so you have 100 shares now. So the amount of the value of the company that you actually own, the percentage of the company you own, didn't change at all. All that they did was they increased the number of shares that everybody had, which decreases the price equally proportionally. And so, it's like, okay, well, yeah, the number of shares went up, but the value of those shares went down.
The same amount, the percentage is the same.
Exactly. And so when the money supply increases, you can visualize it very similarly. The actual value of the stuff in the system didn't change. It's just got a higher price now because it's denominated by a larger supply of money, a larger number of shares. Now, the issue is everybody with $1,000 in their bank account doesn't increase to 2,000, and everybody with 100,000 doesn't increase to 200,000. It's not an evenly distributed increase in the money supply. And this is where the Cantillon effect comes in. When the money supply, it hits somewhere first. It goes into somebody's bank account, and then they spend it on something. And then that money goes into somebody else's bank account, who can then spend it on something. And then that money gets to somebody else's bank account, and so on and so forth. And typically what happens, because it's a government top-down procedure to increase the money supply, it hits the government's coffers first. They spend it into the politically connected pockets, driving up asset
We haven't
prices.
seen any of that.
Right. We've never seen an example of this. And that's why it hits asset prices first, because those people have the means and the intelligence to purchase assets, and everybody they're buying those assets from who is selling them now gets an infusion of cash that can spend that. So asset prices go up first, and then goods and services get bid up as that money works its way into the hands of people who spend it on the things that they actually need. And the final thing is then it does actually increase wages, because you have the cost of living increase. People need a higher increased cost of living. So they change jobs and all that.
You're starting to see that lag effect.
Yeah. But that's why like savers and earners are in the worst position, because everything gets more expensive before they get their increase in pay. Whereas the wealthy who are on the beginning end of that, receiving that new money, they buy the assets first, and then the inflation happens.
Well, and then layered in there is a fractional banking too, where and I don't know, this might sound like a stupid question because of what we're talking about. Is that included in the M2 money supply growth? Because that's what I thought. Because like you have it where it goes into the bank account, but then you can take margin loans on again. And not only can you take margin loans against your assets, but then also you have the ability to then take that $1,000 and lend out $9,000.
Yes.
And so it just kind of ripples it mushrooms into this massive amount of.
But aside from physical cash, that's all accounted for in the money supply, because that money has to go into somebody's bank account. And so it does show the entire value of all that, even though it's money that's been rehypothecated. In other words, it's been loaned into existence. It goes from one loan to another, to another, to another, into other. It's all in a bank account somewhere. And so because very little of it actually gets pulled out in physical paper cash. And so the amount of that is kind of negligible compared to the overall system.
So that's what we're talking about when we say the M2 money supply growth has been growing. And like,
Yes.
this is what I've been hammering home, Joe. And then you talked about it when you came into my group call. It's like, if that's growing at on average of 8%, and then sometimes it was 30, like in 2020, or if it's 4, I mean, it's been negative the last couple of years, which I think is why a lot of my clients are experiencing downturns, because they're seeing that lag effect of like the goods and services where there's money's been sucked out of the system. But back to when I talk about valuations and the build up methodology, it's like, if the risk-free rate is technically 4 or 4.5, yet the money supply is growing at 8, like if we don't acknowledge that, we're looking at the value of our business and the cash flow wrong.
Yeah.
So I'm trying to add this as a factor when we're looking at value, because it's a quantifiable, it's on the Fred, you can see the numbers.
Mm-hmm.
So it's not something that we're just making up here. I think it's just an important thing to note as part of like understanding the game.
It is. I will say though that if you only look at the money supply, you can oftentimes overstate the impact of it and overcorrect for it. So if the money supply increase happens immediately, then you have that effect of like, hey, well, it's more money chasing the same amount of goods and services. But if it happens over a longer period of time, it's not the same economy. You have more production of more goods and more services. You have an increase of wealth that happens along the way. And so imagine we're on a desert island, and let's just say for, we found some gold coins that were buried by a pirate, and we use that as money on our desert island. And there's, a couple dozen of us on this island. And some of us are collecting coconuts from trees. Some of us are fishing. Some of us are building huts. Some of us are making clothes. So we've got a nice little economy going on. If we find another treasure chest full of money and immediately divvy it all up for everybody, that changes nobody's real wealth, right? Because the prices just immediately respond up. Instead of 1 coin for a coconut, now it's 2 coins for a coconut. But what if over time we discover, oh, there's 1 coin that we found buried, and somebody else finds another coin that was buried somewhere. And over time, you are gradually discovering new coins. Well, that's not going to be have the same effect on prices, because I'm collecting more coconuts the whole time. And all of those leftover coconut shells we're using for tools and for little cups for water. And we have more houses that are being built. There's more productivity. And so, yes, you have more money, but you also have more goods and services. And so if the increase in the money supply is gradual enough, sometimes the increase in the production of real wealth can compensate for that. Now, it is true, without a money supply increase at all, then the cost of everything would go down and people's lives would be even better. But when you're looking at just prices, you have to also account for the increase in total wealth, which the CPI tries to do, and it doesn't do it enough, because there's no real way you can actually measure inflation, because when
I was reading the Bitcoin standard,
the
fiat standard, I'm like, it was like there's no unit of account.
There's not,
which is insane. Like, how do you measure how many square foot your house is if you can't measure square feet?
Right.
It's like,
it's
we
impossible.
don't measure it. It's only what people can buy. So if they can't buy it, it's not included. It's like, it's so insane to me.
But even with sound money, money does not actually measure value, because exchange only happens when both parties become better off. So money is used to exchange value, but both parties increase their value from an exchange. And so the money can never measure value. I don't know. Does that make sense? Do you want me to
pull
that apart? Okay.
Well, this is why I watch your YouTube video.
Yeah.
It's a unit of account. Like, I mean, really, realistically, money is just a ledger. I mean, that's when it started.
Yeah.
Thousands of years ago, it was a unit of account of tallies on a cave, right? So like, that's all it, to your point, right? That's all it is a unit of account who has what. Mm-hmm. Fair. I mean, so therefore,
like an IOU for society, it's where you store your wealth until you're ready to redeem it. You store the value of your wealth until you're ready to redeem it for real
which
wealth.
is your time. Back to how we started. It's the time stored up that you did doing something. Yep. So I'm tracking it.
Okay. All right. So we got off on a buddy trail there. So let's pull this back to where all the money is going to come from for the debt rollover. So first of all, when the debt gets rolled over, it's like getting paid back. So it's like, all right, well, I'm going to go to my lender. I owe you $100,000. I don't have it. So at the same time, can I please borrow another $100,000 from you. And they're like, okay, yeah, but you also owe me interest. You actually owe me $110,000. So I'm like, okay, well then can I borrow $110,000? And in, 10 years from now, I'll pay you back $120,000 or whatever it is. So that's how most of the debt in the system happens. Definitely for the U.S. government, but also on a net aggregate basis for private individuals.
Isn't that's tied into that 3-year refinance cycle that Rob Paul is talking about all the time, right? Which the business cycle is tied to, isn't it highly correlated to that refinance cycle? I mean, am I wrong or
Maybe.
right on that?
Okay. I'm not sure. I haven't seen exactly what you're referring to there.
It's just yeah, and I might have to do some more research on that, but it's a lot of this has to do with like, hey, because of how the notes are structured and the debt structure, there's this refinance cycle that's very predictable.
Are you talking specifically for the U.S. government?
No, the business cycle.
Okay,
yeah, I'll have to go back. Yeah, I'll have to go back and I'll have to do some digging on that.
All right. Yeah, I haven't seen that, so I don't know. Specifically for the U.S. government, what they've been doing over the last 6 years is every time they roll over their debt, they've been borrowing at shorter maturities. And so they're like, all right, well, this money I borrowed 10 years ago, I have to pay it back right now. But instead of borrowing with another 10-year bond, I'm going to borrow and I'll have to pay it back in 2 years. And they've been doing that because of a couple of reasons. Number one, the interest rate. Typically, the interest rate is lower on shorter term debt. But number two, because there's not a lot of liquidity at the long end. So if they said, hey, we're gonna borrow, and pay it back in 10 or 20 years, there's not a lot of money in the system that is willing to lend to the US government for that length of time at current rates. So if the government was rolling over to 10 and 20 year bonds right now, the interest rates on those would be a lot higher. And so what they're doing is saying, we don't want to.
Can I give you my layman's explanation of why I believe that is? Again, correct me if I'm wrong. So you have sovereign wealth funds across the world. So there's different countries' savings accounts, and then you have pension funds, endowments, insurance companies, and investment funds and banks going like, well, if I lend you the U.S. government, $1 billion at 4%, and we don't see a path of productivity and of the ability for us to get, like, they're just locking in a loss. If they're right. I mean, that's why they're not willing to do that, is because it's like, well, if it goes 10 years or 20 years, like, I'm guaranteed to be underwater.
Right.
So there's more appetite at the shorter end of that because of the money growth.
Because it's like, all right, well, I need to put my money somewhere for the next year or 2 years. So that's fine, because then I maintain the liquidity. There's not as much interest rate risk. I can, get it back sooner. But if I'm going to lock it up for 5 or 10 years, then I want to make sure I'm getting a return that I know will exceed inflation. And given the debt to GDP ratio and the cost of the interest on the debt relative to the debt pile, the deficit that the United States government is running every single year, it's very clear that 4% is not enough for the next 10 years for that magnitude of debt. Maybe for a little bit, but not a lot. And so they've been rolling it over at the short end. And so that's why for the last couple of years the government has so much debt that they're rolling over. When they do roll it over, it's not like they need the full $10 trillion to come from somewhere, because they are paying it back and borrowing at the same time. So they need the interest difference. And that comes from bank lending. So we talk about the Federal Reserve, but underneath that are banks. And that's where a lot of the lending happens, especially because the Federal Reserve is not adding to their balance sheet right now, but banks are. And so that's where the lending comes from, is from financial institutions and banks who have the legal right to lend money into existence. And so that's where the extra money is coming from. That's why the money supply is growing. And as the government rolls that debt over, it gets lent into existence from banks, and that increases the money supply. It's the difference of the interest.
So what I've been following is I can put some of these images in the show notes or links to these, but like, there was the current liquidity ratio or something of the banks. Did you see that one? It's just getting worse, because what happens is these banks are sitting on all these bonds that have low rates. And if they were to sell them, they'd have to take a loss.
Yeah.
So they're technically underwater, like and it shows like the financial crisis and now. And have you seen that whenever it's like green and red? It's been floating around X, but like, and it's just like, what in the hell?
Yeah.
And then I was just interviewing ITR Economics, and we were talking about some of this stuff too. And he's like, they prove like what happened with Silicon Valley Bank. I mean, like they're just going to throw it through the system. But like you had some, I can't remember what video or how you described it, but it was like the mechanics of how they're going to do that through the banks, even though if the banks are truly upside down like that, correct me if I'm wrong, but then also like there's ways I think you described of how the accounting can be changed, or there's rules in place of like, it's kind of all set up to kind of handle it right now.
Exactly. Okay. So the losses right now on banks' balance sheets are not the same as they were a couple of years ago. A couple of years ago, they were largely treasuries. And so what the Federal Reserve did was say, hey, well, these treasuries are going to get paid back at maturity, that they're not going to get defaulted on. So we don't want you to have to sell them at a loss right now. So just give them to us for a little bit, and we'll give you the cash for the full value. That's what the Bank Term Funding Program was. And so it'd be like you bought a house for 500 grand. The market crashes, your house is worth 200 grand. And you're like, well, I know in 30 years, it's going to be worth 500 grand. So the Fed says, okay, well, just sell it to me for 500 grand then right now. And in 2 years or in a year, you can buy it back from me for the same amount. And so that's what banks were doing. They were saying, okay, we're going to get the full value from the Fed to let interest rates kind of normalize here and get our make sure that we don't have a bank run, basically. And so because
the fucking shenanigans is just unbelievable. I mean, it's just ridiculous.
But it was because it was with Treasury.
I get it.
Right now, all the losses on the bank balance sheets are with commercial real estate and specifically office space. And so the risk for some sort of big financial crisis with banks being in trouble is basically zero right now in the United States, mainly because the Fed has set the precedent of, hey, if things get bad enough, we will open up the BTFP again, and banks can offload their treasuries to us for full value, for a year. So a bank run is impossible because the bank can then meet all withdrawal requests. And if a bank can meet all withdrawal requests, a bank run doesn't happen. And so then this,
because just to be clear, because they're getting parked on the Fed balance sheet instead of the banks. So you're just swapping them, is what right?
Yeah,
what you're
because
saying, right?
when
so
you deposit your cash in a bank,
I'm tracking.
They don't just keep
have
it.
to invest it.
They loan it out to somebody. So if everybody deposits their money and then says give it back, the bank doesn't have it. They have to sell those loans that they just made. So if they have to sell their loans at half the price, half the people aren't getting their money. And so if they're doing that through the swap at the Fed. Yeah, they temporarily swap that to the Fed so that they can have all the cash. And if they can't have all the cash, nobody needs to get their money out. And so people stop. The way that this relates to the what will happen probably soon with treasuries is that if the government needs to borrow and can't, then the rules for how many treasuries banks can own will change. Because right now, treasuries have a risk limit on them. So banks have a limit of how many treasuries they can buy. But because of the BTFP and because of the reverse repo facility and the repo facility and the Fed backing banks up, treasuries are basically now the same as reserves for banks because there is no risk on them for banks anymore. And so with a couple tweaks like that, a bank would literally be able to buy as many treasuries as they wanted from the US government. And they're printing this money into existence. So banks would take over the role of QE instead of the Fed, and the government would be able to borrow as much as they wanted from banks.
It's such a freaking sham. It's because I just think about like how like all of my clients, like we have to make more cash flow to make it all work.
Yeah.
There is literally a binary situation where your cash in the checking account is either zero or above zero. And like and I think it's so important to understand, like for me, it's been so monumental, Joe, because understanding this is great. Okay, how does this impact then my investment choices of capital allocation with my business and my income? And so back to then, as this money supply growth happens, and I don't know if I haven't seen any I haven't seen any M2 supply growth or anything like over like, I mean, I think I've seen some. It's hard for me, and I'm very cautious of like what's clickbait, what's like over dramatized for someone to get, get their views. But like knowing that this is the thing, like we have to refinance all this. There is going to be commercial real estate issues. Like, well, like there absolutely will be commercial real estate issues because of vacancies and interest rates, and the cash flow doesn't support the value. But like, how does this then impact then the money supply growth, and then like what's possible, like what's going to happen with the money? Because like, and here's some reasons behind the question is ITR Economics talks about a 2030 Great Depression. And actually, Alan, who was just on the show, who's part of this segment, he was just on stage with Peter Zion too. And so like they're always, and Alan said, Ryan, it's not doom, 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 the end. It's doom, doom, doom. Then there's great prosperity after the structure. There will be some sort of thing going on. And it has a lot to do with the baby boomers who are taxed, because there's 30 million people who are going to go from revenue generating to a tax in the system. But all of this is just more issues. And even whatever Doge does, I mean, I don't see a path, I guess is my point, Joe. And I'm like in cash flow statements all day long. And I'm just interested to going, okay, yes, I hear what you said, but then what?
Yeah.
You know what I mean? What is the ripple effect of all this?
Well, you can either inflate your way out, you can deflate your way out, you can go through austerity, or you can produce your way out. So those are the only four options. And
which is generate more cash flow, cut spending, inflate, meanings you're like melting away your debt because you've inflated everything, where just the 35 trillion is just less.
Yeah, well, I'll give you the extreme examples of each, because that helps the perspective, and it won't be an extreme. It'll be a mixture of all of these. If you inflate your way out, that'd be like the government today saying, hey, we are taking control of the Fed. We are printing $36 trillion. We are today going to, in advance, pay off all of the treasury debt. And we are no longer going to borrow. What that does is it's called inflating away the debt, because you created the money out of nothing in order to pay back the debt. And all that new money is now in the hands of people who had that capital locked away. And now they have to do something with it. And so they're going to deploy it in the private economy. They're going to invest it. They're going to buy assets. They're going to lend to other people. So it creates an inflationary boom. Usually those happen over longer time periods, but that's what happened from 1940 to 1980. It was an inflationary deleveraging. The government got rid of all of its debt from 120% down to 30%.
Okay, question there. Got you, tracking you. I follow the demographics like ITR and Peter Zion. It's like baby boomers came back, and then there was all these people to buy shit and do shit and make work and all this stuff. So there we could grow our way. Like that was hidden. FDR's, like all that stuff was hidden underneath the productivity cash flow boom. Yeah. And then like I hear like, the All In podcast guys talking about this, and I know David Freeberg talks a lot about this. It's like, got it. But I'm sitting there going, we have 80 million old people retiring. And then we have a bunch of younger people who are not necessarily as wired the same way for work and then I literally like, I hear this, hopefully AI will be there. And I'm like, so like how much it hinges on, like when I look at a forecast of a company, it's like, what are the probabilities of us hitting this forecast? And then you just kind of go, so am I thinking about that the right way?
Yeah, you're just combining, like trying to figure out what mixture of the four ways out of this are we going to have? Yeah. Because the reality is we do get out of this. It's just, when is the pain? How much is the pain? And who bears the pain? Because you cannot consume what has not been produced. And there's been a lot of consumption, which means that it needs a lot of production to compensate. And so the question is, who's going to pay the price? It's not, are we going to escape the pain altogether? So inflating our way out of it is the historical method. And so far, it looks like that's the way that we're going down, because the spending at this pace is not decreasing anywhere near enough.
Right.
Let's say we do get there. Then austerity is the second method, where it's like, all right, we're going to pay this debt back honestly. And we're going to cut spending and keep on taxing and get to the point where we are running a surplus and the debt starts moving down instead of up. Now, that is very, very painful for taxpayers, because you don't have an influx of cash coming into the system anymore. You have cash actually leaving the system. The money supply decreases. The opposite of running a deficit, it's a surplus. Money literally evaporates. The money supply goes down. And the taxpayers are paying the brunt of that. because it's coming from a surplus. There's no more lending to the government anymore. And so you have deflation, and you have a large burden on taxpayers. The third way out is to deflate your way out. And I'll point to the extreme, which is just straight up defaults. So the government just says, we are not going to pay. The national debt is null and void. We are no longer making any debt service payments. At that point, obviously, big default there, but all of the money that people were expecting to receive in return from that, like the banks, the financial institutions, the pension holders, all of that, now that's a zero on their balance sheet.
Yeah, right. There's
so,
I mean, that is like active war almost to the point. I mean, like you had, complete chaos.
Yes, instant deflation everywhere, and you have a lot of short-term pain. Similar, but to a greater extent, that you had in 1920 for the first Great Depression, where there was a lot of deflation, and it would be very short, actually. You'd have a new lender, or a new borrower that would emerge as the most borrow-worthy, most debt-worthy lender, and there would be new debt that would take the place as the bottom of the financial system, that foundation.
You're almost like recalibrating productivity of like people that are willing to provide value to the economy, right?
And the main people who pay the price are the lenders, which the main lenders have been the ones that have been profiting off of lending money into existence this whole time. And so there is a case to make that the outright default, because the government actually can't pay it, is the most moral choice, because if they default through inflation by printing, that's still defaulting. It's just somebody else pays the price. Now, the next thing that we have to talk about is productivity, because that's the other way out of this. If, let's say, all production 10x's over the next 5 years, everybody gets a lot wealthier, and the government can confiscate a lot of that wealth in order to pay down its debt. And so GDP goes up, their debt goes down, they deleverage as a result of confiscating a lot of that new wealth that's been created. But we don't feel the pain of it because it's coming out of extra production. So you have somebody who goes from making $50,000 a year to $500,000 a year. When they were making 50, their $50,000 credit card loan felt really, really painful to them. When they go to making $500,000 a year, they pay it off, and they're worse off than they would have been otherwise, but they're still overall a lot better off. And so if we do have the ability to have massive deregulation in energy, massive increase in production of energy, keeping regulation low with technology and AI and robotics, increasing the grease on the skids for economic production. There is a case to be made, especially if we can lower taxes along the way. There's a case to be made that production can increase a lot. That's what Argentina has done. They've decreased taxes, decreased spending, and their economy is booming. And the only people who are hurting were the ones who are receiving government money and are no longer receiving government money. Everybody else is doing a lot better. And so there is precedent for it. It's just not very likely.
Thank you very much for putting that framework around that, because and are you doing okay on time?
Yeah.
I want to make sure, because so we'll land this plane and we'll figure out how to put a bow on this. I think it's because those things run through my head all the time, Joe, because like all I do is that I look inside of strategic plans that are tied to 3-statement financial forecasting. And it's like, are we predicting the cash position? Like that's what I'm constantly doing with my clients, given all the things that we know. And I keep going, I don't see a way out of this. And then but it's a little bit different as you throw in all the different things a centralized currency across the globe can do. And then I just think through it, and what I was talking to Alan from ITR about is like, they're going to try and thread that needle of all those 4 different things that you just talked about. I don't know what that tightrope looks like. And I don't even know how you could put this into a financial model, because you have all this accounting gimmicks and all this shit that can come out of thin air when it really, and it takes a while to flow all the way down. And so that's why I think it's so fascinating. ITR has been talking about this Great Depression for 2030 for a long time. And they do a lot of you would be fascinated with them as well. And so I kind of look at the next 5 years and go, and I don't know if the strategic Bitcoin reserve is going to be like a hedge against this. And it's just like, we're going to try and walk this tightrope, and we're going to have this kind of like, hopefully this hedge as this goes up. I mean, is that kind of like, that's kind of how I viewed it, going like, this, not going to be something dramatic like this, but like if we accumulate some of this over here and this whole thing collapses, we've kind of like what you and I would do with our portfolio. I mean, how do you see that?
Yeah, I think if we can play it out to like what might be like a good case scenario for that is, number one, I think that's tied in with the sovereign wealth fund. So if you look at a on the balance sheet, revaluing gold to market value for the U.S. government, accumulating more Bitcoin, and then
assuming we have the gold,
which, by the way, I think that when they audit it, there's going to be a lot more than what people thought there was. And then the question is going to be, well, where in the world did it come from and who did we steal it from?
Well, and the money or the gold that's been moving, I can't remember Luke's last name. He was on Breed Loves What Is Money, and
from England.
Yeah, like, man, like how much money came over from England over to New York and stuff like that.
Yeah.
There's shit going on between the countries, and Russia and China are already trading in gold and oil. I mean, it's just fascinating. And so, but when you said like revalue the gold, because we've got gold on the balance sheet, but it's at the old price, right? So we could mark that up and then borrow against that or something like that. Is that
borrow
what you were
against
alluding
it?
to?
Yes, because then you make a bigger push globally for remonetizing gold. And maybe the gold bond, this is something Judy Shelton has done a lot of good work on and has Trump's ear a little bit. A gold bond would maybe just have the option to be redeemable in gold, or at least redeemable in the dollar market price of gold. And so you issue bonds, maybe not for the full extent of the government borrowing, but you do that for some. You issue some Bitcoin bonds and some gold bonds that puts some level of financial responsibility back on the government. And then as that incentive increases for now other nations, by the way, if you are going to get an option to get paid back in gold or the dollar value of gold, you're going to be willing to lend to the US government at 2%. So by doing that, they're going to be able to roll over part of their debt at a much lower interest rate to get rid of the interest rate spiral that they're in right now. Other countries now see, okay, well, if we can do the same, then we can borrow at a lower rate because there's actual collateral behind it. And so that remonetizes gold and potentially Bitcoin as well. And it also puts an anchor on financial irresponsibility for the government moving forward, because you get a new administration in that wants to just blow up the spending again. Well, they can't, because now if you want to borrow in pure fiat, your interest rate is too high. You can't afford it. And so you have an anchor that's been reattached to ensure some level of financial responsibility for years or decades to come. So that the optimist in me would hope that something like that is in the cards.
Well, and super helpful, man. To me, honestly, because like it's like you have the four different options. There's probably going to be a balance of all of those for productivity, cash flow, all the different stuff you just mentioned, using the banking system as a way to continue the machine so it doesn't completely implode. So you go, okay, we're going to try some of these four options, a combination of them. We're going to use the banking system. We're going to go over here and then try to anchor us in some sound stability. We're going to do some sort of cuts right now, publicize them, make sure that people see we're trying to do some stuff. And then all the shenanigans going on with tariffs. I mean, it's all of this shit, right? I mean, I've been through a turnaround, man. I know it's like you do it all. and I think that's the thing that it is so beyond most people. Like, we're bankrupt.
Yeah.
Right. Like and we're trying to figure out how to navigate that without completely collapsing everything. And you've just laid it out in a really interesting way, because my brain just stews on all this stuff and I try to see the path. And it's probably a combination of all of those while continuing to fly the plane.
Yeah. Yeah, for sure.
As we wrap here, anything that people should go to your YouTube channel. I always recommend that. Go to Joe's YouTube channel, Heresy Financial. Put the link in there. Awesome short-term videos that are just fantastic. I just appreciate that so much. Things people should be watching for between now and maybe the next time we chat, like, indicators that you're paying attention to, saying like, are we on track or off track of threading this needle?
The biggest thing that I think we're watching right now is the 10-year yield. If they are able to get that to move significantly lower, then that means that means we've got some good economic times ahead of us, in terms of maybe it might be false booms, but we might have a boom up in front of us here. And by false, I mean fueled by a new explosion in the money supply. Maybe not explosion, but a new advanced growth in the money supply. The other thing that I would be watching,
which is good. Wait, bro,
yeah.
Can I pause you there for you? Because but that is relatively good. Yeah, like subject to, yes, there is inflation of the money supply, but there is this extra juice for business owners, for lending, there is some wiggle room there, to your point. And that's where I watched that chart, whether it correlates to Bitcoin or it correlates to productivity. And ITR Economics has their leading indicators that show so their indicators and forecasts is growth at the end of 2025, 26, and some of 27. And that's where that's coming from, is what you're talking about. Is hey, there's going to hopefully be some of that juice there. Is that a fair statement?
Correct. And I think it's important to point out that there's always a good long and there's always a good short. And so when you say good or bad, usually you have to, with nuance, you have to ask the question, well, good for who and good for what? Because you can play both sides of this. And so there's, when times are coming to a point where the money supply starts to get scarce, you want to be deleveraged, because then you can buy up assets that are on sale. This is private and public markets as well. And so you want to be the Warren Buffett. You want to have cash. You want to have no leverage. You don't want to get a margin call. You don't want to get stopped out. You want to be the one buying the deals. And that is very good. Very, very good. That's how you build fortunes. And then when times switch and money becomes more abundant and money starts flowing, you want to redeploy that, and you want to be able to go all in. You want to add the leverage. You want to do the spending and the investment, because people have the ability to purchase. And so you want to be able to play both sides of this. And so you watch the money supply growth, you watch the 10-year yield, and above all, I would say be fearful when others are greedy, and greedy when others are fearful.
Oh, Joe, you're the best, man. I'm so appreciative of your time. That was a great little recap. You also have Heresy University. I think that's what you call it, right? And you help people with asymmetric trades and a bunch of shit that is just unbelievable from the level of education that you provide on the YouTube channel. I highly recommend people check it out. Any thoughts on that? I know anything else you want to say on that?
No, I always just push people towards my YouTube channel if they're interested in getting more, because that's where I put up basically the vast majority of my my information. And so I'm constantly watching the markets and talking about what I see, and teaching people how to interpret it so that they can make more money. So let's start there.
Therefore, more time and freedom.
Yes.
Joe, thanks so much, man.
Thank you.
Thanks for tuning in. I hope you enjoyed that episode. I'm constantly learning. I'm constantly paying attention to this. I think it's so damn important, because understanding how the economic machine works, how the bigger picture is playing out, will help us all make better decisions. Because whether you're trying to grow your company and buy other companies, whether you're planning on selling, or whether you're optimizing your margins, understanding the context of where we're at and what's going on, I think will be super helpful. It should mitigate some of your anxiety, put it into context where you're at, and then allow you to make better bets. And I think understanding how money works allows us to then treat our company like an asset, and then understand how to allocate capital in a way that allows us to make better bets with our time and our money, so that way we have more independence, because that's the whole point of doing all this hard work that we're working on within our companies. Thanks for tuning in. If you enjoyed the episode, share it with someone else, give the podcast a rating on the podcast player, and I will see you next week.